The Sintra story as well down in Portugal. So a lot to fold into the markets this morning. As Credit was indicating, it looks like the FTSE 100 is opening higher. Is the FTSE 100 going to do better if we see political turmoil elsewhere? Some evidence for that. There's an interesting story on the Bloomberg talking about that story as well. DAX looks like it's opening positive as well. The stock 600 is up by 0.2%. As ever, we wait for the French market to load, and there it is, up by 0.5%. Maybe not actually significantly outperforming thus far on the back of maybe an easier political narrative for the markets to digest. That's interesting in itself. So we'll see how the French market tracks its way through the rest of the day. So Europe is open. We are up cautiously higher, I would argue, Critty.
I think that's a fair assumption. And when we look at the French index, I'm going to start there, given the political turmoil. We are seeing slight underperformance, but still green on the screen. Of course, led higher by your luxury names, but also energy, Anna. Total keeps continuing to make gains, for example, not just in the French index, but it's a theme you're seeing in the FTSE as well, because the leadership there, alongside your ASMLs, your big heavyweights, is your oil companies.
Yeah, absolutely. And the oil price, 86.74, as you point out, we are seeing a little bit of upside there. And that I was looking at that earlier. It does stand out in the GMM, that size of a move. So it has got some scale to it. So that could be something we watch. But energy names actually pretty flat this morning, just a tenth of a percent. Focused on those basic resource stories, though, Critty. And we do see that sector doing really well this morning, up by 1.75%. Antofagasta, Rio Tinto, both higher. We saw iron ore prices up by more than 3% through the Singapore session, so perhaps that having something of an impact.
But when we look at the... Go ahead.
Sorry, no, go.
I was going to say, for some of the individual movers that we've got our eye on, again, it's the heavyweights that really catch my eye, because ASML, again, is going to be one of your biggest index contributors. You can already see one of your best performers on the Eurostoxx 50 right on your screen there. But to the downside, it's also a tale of heavyweights. Novo Nordisk, for example, dragging the index lower as well. That likely coming from the Biden guidance overnight, saying that they're actually going to be looking at the pricing for the likes of Ozempic and Wegovy. That is significant, because remember, it's a big part of his drug pricing agenda. And I think a massive amount of that obesity drug, the consumer demand, comes from the States. So if you can't make that kind of margin, that's going to hit your bottom line. Novo Nordisk taking the hit this morning.
I don't see a trade yet in Rheinmetall, which I think is interesting. 550 tanks. This is the Panther tank, the new tank that this company is producing. It looks like Leonardo potentially is going to be involved in that trade as well. So we're waiting maybe for that to open and give us an idea of how the market is going to take that story. Plus, we've got an upgrade on that stock story as well. So we'll keep an eye on that. That's certainly going to be one of the single stock surprises maybe out of today's session.
And just as you speak, I think we are getting those opening trades higher by 1.9%. But again, a light volume, just starting to trade, so we'll bring you the update there. But as we walk you through some of those individual names, it is still that macro overhang we're talking about. We're talking about the geopolitics, but monetary policy absolutely matters. Yesterday in Sintra, we heard from both Powell and Lagarde. Take a listen to what they had to say.
We want to be more confident that inflation is moving sustainably down toward 2% before we start the process of reducing how tight our policy is, of loosening policy. Frankly, because the U.S. economy is strong and the labor market is strong, we have the ability to take our time and get this right, and that's what we're planning to do.
We still believe that it's likely to be a bumpy road until the end of 2024, but we still have target at the end, in the second half of 2025, on the basis of our projections, and the baseline is unequivocal on that front.
Jerome Powell and Christine Lagarde. They're speaking at the ECB forum in Sintra. Let's get a little bit more analysis here when it comes to the markets. Emma Wall, head of investment research and analysis over at Hargreaves Lansdown, joins us this morning. Emma, pleasure to have you on the program. Good morning. Let's talk a little bit about this macro story. We hear the same narrative over and over again from Chair Powell, from Christine Lagarde. I'm not sure we necessarily learned anything new. When it comes to how that shows up in the stock market, is monetary policy priced in?
I think some monetary policy priced in. I actually think markets at the moment are reacting far more to political fever, and we can come back to that. You know, it has been very much over the last 12, 18 months, markets that have been driven by expectations of what happens with interest rates. You know, lest we forget that at the end of last year, we were pricing in 6 cuts for the Fed, several for the ECB and several for the Bank of England. Those didn't materialize. But I think what we have heard from that rhetoric, I know you're saying we're learning nothing new, but that is what central bankers are trying to do here. They're trying not to surprise markets. They're trying not to scare economies because there are so many levers at play. I thought it was very interesting what Powell said about the robust economy for the US. We are still seeing growth in the US, but some of the jobs market figures are actually looking softer. I thought it was a really interesting report that came out from BOA last week that actually showed that salary rises through when people move from job to job have actually softened, come off from where they were 6 months ago. So obviously that wage inflation is softer. That will flow through to inflation. So I do think consumer remains robust and the jobs market remains positive, but some of those inflationary pressures are easing, and so that will then pave the way for the Fed to be able to make cuts in the second half of the year.
So that's the monetary story, but when we talk about the Fed and then the ripple effects into the economy, does geopolitical risk play a role here, or is this something that's largely seen as temporary?
Well, I'm going to be really selfish about this because I'm obviously talking to you from the UK and we have absolute election fever here at the moment. And if you think about what's concerning our clients and indeed what's wobbling the market, it is very much the fact that polls are going to open in the next 24 hours, you know, and very much in France, you were discussing it earlier, what's making markets wobble? Well, expectation of what happens with Marine Le Pen's party and the prime ministerial role that will be resolved next week. So although monetary policy still drives markets, I do think for the moment, at least for the next 6 months, and we could come back to Biden, you're probably far better versed on that than I am, being US, but geopolitics does play a part, at least in the short-term volatility. And we've been looking at some of the sectors that will be impacted by the UK election if, you know, the expectations are correct and Labour does win the election tomorrow, what that does for certain sectors. And also we've been hearing from our clients, and it is something we've been getting a lot of incoming contact on, you know, how will an incoming Labour government impact not just my investment sector by sector, but also my finances, because of course there are tax implications to an incoming government as well.
Yes, I should point out, Critty's here with us in London, Emma, here with us in the UK, as I know you are. So she's living the election fever, as you describe it, to the extent that we have that with us at this point. Thinking about where the fever is, I mean, markets seem more animated by the French story at this moment because a lot of what is set to happen in the UK seems as if it might be priced in, Emma. Is that true for the oil and gas sector? I'm thinking here of smaller names that maybe have been more volatile already around what the Labour Party would plan to do with the North Sea. What conversations are you hearing on that front?
Yeah, I think that's one of the really interesting sectors that we are seeing an impact. You know, there have been elections before where actually parties are really aligned on policy and it doesn't really matter sector by sector who gets in. But oil and gas and a Labour government is very different to oil and gas and a Conservative government. They have very much indicated that no new licences, you know, will be awarded to oil and gas. They've made noises about additional windfall taxes. You know, they are very much committed to accelerating the net zero plans. So companies that are involved in electrification, you know, diversified oil and gas companies who were perhaps investing in renewables, we expect there'll both be a carrot and a stick when it comes to the net zero policies. So oil and gas is one of those sectors that we do expect to see an impact.
Yeah, and whilst the big names listed in London, of course, have international businesses, some of the smaller ones will be more exposed to those dynamics that you describe. Let me ask you about your expectations on the Bank of England, Emma, because I know that there is an expectation that we get an interest rate cut at some point this year. I was looking at a note from Deutsche Bank yesterday, though, talking about risks to the upside for the UK economy. Growth has come in better than expected. Investment may be encouraged by political stability. Balance sheets and real incomes for UK consumers have improved. Sentiment improving for consumers and businesses. I wonder if there are upside risks to the economy and therefore how certain you are that we get that cut from the BOE.
I love to be in a position that we are worried about being so optimistic about the outlook. It's been a while since we felt that about the UK economy. I think potentially that's overstated. There's still considerable negativity baked in. You know, we are on a significant deficit. There's a lot of debt in the system, both in terms of corporates, the economy, and consumers. You know, although interest rates are looking to come down, they're not coming down yet, and we have got a number of loans that we expect for corporates and consumers to be rolling off in the next 6 months at considerably higher rates. So there is still quite a lot of risk in the system. I think the pressures on the Bank of England, now that inflation is at target, and you do have that debt burden across those three spheres, will be to cut rates in the second half of the year. So our expectation is very much that rates will come down.
Emma, good morning. It's Guy. Can I take you back to the UK and figure out maybe in a little bit more detail what is happening here? We've talked already in this conversation about kind of the risks elsewhere and what is happening in France, potentially what's happening in the United States. Does the UK look like a sort of bastion of stability right now? Does the FTSE 100 look like it has that kind of those characteristics? Does the UK market outperform when others are doing less well in terms of the kind of the political narrative? How should I think about the UK versus Europe?
I think there are a couple of factors at play here. Firstly, let's strip out the geopolitics and just look at fundamentals. Although the UK market has done better this year than it has done in previous years, you know, even outpacing the S&P 500 for a section, you know, we still believe that the UK stocks are significantly undervalued. You know, we've talked about this before. You know, looking at a fundamentals point of view, you know, on a cyclically adjusted PE, UK stocks are still undervalued, and yet they've got low levels of debt, sometimes high levels of cash, and you know, well-covered dividends in a lot of cases. So if just from a sort of a longer-term fundamentals view, we're still pretty positive on the UK. From a relative point of view, I do think, this is anecdotally, I've been talking to clients looking at asset allocation who've been saying actually they've been waiting for political stability, which we haven't had in the UK for quite some time. It's been, you know, a high tempo 5 years, shall we put it, in terms of change in politics. They're looking for stability in order to take advantage of those fundamentals, so they can see, you know, taking all emotion out of it, but this has potentially got some great upside. But they've been waiting for that political stability in order to make that investment. So I do think the two factors together do make us quite bullish on UK. What I would say, however, is I wouldn't count the European market out. I think France in particular is interesting because we have got an example of a right-wing, indeed female leader in Italy, which people were very worried about, the sort of policies that they would bring in, that government would bring in. But actually, you know, politicians aren't stupid. You know, there are some policies which would significantly disrupt the French economy and indeed upset the ECB. But I would expect actually for them to play the long game. And so there is then about politics with a small p and how that comes into play, and how much of the rumoured and concerning policy does actually flow through if they're successful in the prime ministerial race.
I'm going to stick with the UK, if I may, for just a moment. Capital gains tax. How worried should I be? Should I be selling today if I need to maybe think about if I think the capital gains tax is going to go higher? Are you seeing that? What are you advising clients right now? There is a lot of ambiguity around what a Labour government would do on this.
Yeah, so I think capital gains tax is one of the personal taxes that Labour hasn't ring-fenced. So they've been quite vocal about the fact that they won't be adjusting income tax limits. So capital gains is kind of the elephant in the room that they haven't addressed. And we do know that they're going to need to raise money in order to fund some of the initiatives that they've already spoken about. The first thing I'd say is none of this is certain. We very much expect a budget to happen in September, and we always ward against acting in haste and, you know, repenting at leisure. What we would say is take advantage of the allowances that are available to you now, both in terms of pension, personal allowances, and do start to think about if you have done well, perhaps now is the time to crystallise some gains and to reallocate. But we'd also say investing should be for the long term. We've done some analysis on, you know, how your money would have done under Labour and Conservative governments, and actually the best way to invest your money is to be politically agnostic and focus on the long term, because actually the best gains were made through both periods of kind of leadership and just focused on the long term.
Emma, thanks for catching up with us. Emma Wall, Head of Investment Research and Analysis at Hargreaves Lansdown, joining us ahead of tomorrow's election here in the UK. Let's take a look at some of the core stocks that we watch here in Europe to give us an idea of what the market really is doing. And as you can see, broadly positive. Nestle a little bit softer, but not by much. Novo Nordisk, unsurprisingly, given the politics coming out of the United States, a little softer as well. But elsewhere, we see some gains. LVMH, Ferrari, ASML, Schneider, all picking up, Anna.
Okay, let's check in on the individual stocks on the move this morning. Joe Easton has a briefing for us. Joe, good morning.
Morning, Anna. So I'm going to start with the morning calls today because these are what's driving the big movers on the gainers today. Take a look at this one, BE Semi. This is upgraded over at Morgan Stanley today. In a note, they're saying that they suspect Apple might start using the Amsterdam-based company's technology. This is the chip manufacturing machinery firm, and as such, a 5.7% gain in that one. Morgan Stanley has a 190 price target, plenty of upside on that stock, and that's the best performer on the Stock 600 this morning. We've also got a couple of morning calls in retail, a couple of very different calls on these shares today. Firstly, we're going to take a look at JD. Now, this is the only sell rating on this stock, and it's coming from Barclays following the weak earnings from Nike just a week ago. That viewers will remember sent JD Sports lower, and Barclays putting out a warning saying this is a signal for the company. Nike accounts for around 50% of the firm's revenue, so that one is dropping on the FTSE 100 today, down 3.8 this morning. A bit of downside in that stock. But going the other way is H&M. This is the Swedish retailer, the discounted retailer. This one is upgraded over at Deutsche Bank. They say investments in the company stores and also some newer brands that they're bringing out are going to boost that company. It's a double upgrade today, going to buy on that stock. We're up 1%, 200 SEK price target, so a bit of upside there as well. Then we're going to look at Rheinmetall. Anna mentioned that one earlier. We've seen that deal news in Handelsblatt, potentially 550 tanks being sold to Italy, getting a decent gain on that one, up 3%. That's a stock that's doubled in value over the past year. We've also got, though, the Morgan Stanley upgrade that you also mentioned earlier, so a double boost for that one today. Rheinmetall rising in Germany this morning. We'll take a quick look at Sanofi. Not too much movement, but the company's Dupixent drug has been approved for chronic lung illnesses overnight. That's coming from the European Union, the US and Japan also looking at this drug as a potential treatment for lung illness. It currently is a treatment for asthma and a couple of other drugs as well. It does around $10 billion already in revenue, potentially a boost for Sanofi. We'll check in on insurers. A big drop yesterday, very exciting. The insurance index did have the worst day in around a year following the tragic news of that hurricane that has spread now, but has been downgraded to a category 4 instead of 5. But we are seeing weakness again. All of these stocks fell around 5% yesterday. Zurich, Swiss, Hanover Re and Munich Re all weakening once again today, but not as much as we saw yesterday. Then in terms of your deals, we got a few in the UK this morning. One of them was Anglo American, potentially looking to sell that mine over in Australia that saw that fire earlier this week. That could potentially be part of the BHP deal that fell away. Keyword Studios, finally confirmation of the takeover for the video game designer firm. And Vodafone is doing a pact with Virgin on its telecoms network. And finally, down the bottom here, we got GlaxoSmithKline as well. That one coming in late to do with their vaccines on COVID and also some other respiratory illnesses. That one's a deal with a US company. Not too much movement in that one, but plenty going on in the deal space this morning.
Yeah, there is plenty going on. It seems to be creeping back up as a theme, doesn't it? We'll remember to check in with the various banks we'll speak to around earnings season on that theme. Joe, thank you very much. Joe Easton from our equities team. I mean, absent, there is some deals flow, not talking about big deals, massive deals here, but there is some deals news to talk about, I guess, and that is a theme that we'll continue to revisit through 24. But in terms of where we are right now, basic resources still the best performing sector, up by 1 3/4% this morning.
So what is that on? Is that just on? I can't see any better China data that would give that sector a lift.
Yeah, I mean the iron ore price was higher, but why? Yeah,
not really.
NI Ferro. I'm calling up right now. Talk amongst yourselves.
This is us trying to maybe post. I love it the way we apply sort of narratives. Kind of. Let's try and we've got a stock move. Let's try and figure out a narrative, and we'll pin it to it.
Well, I'll give you one. Look, we talked about this at the open. Light liquidity, light volume going into it. Sometimes that just mean green on the screen. It just means everyone's on autopilot. People aren't necessarily taking cash in or out. And we already saw it. last week, of course, with the rebalancing. We saw it yesterday as well. There was a little bit of a sell-off. So I feel like maybe people are positioning for the U.S. to be out yet tomorrow, and more of the excitement will happen on Monday after we get that answer from the French.
It is a slightly complicated market, as we saw yesterday with NVIDIA not playing in the rally much, other techs playing, Tesla certainly playing, and we'll certainly get to that Tesla conversation next. It was supercharged in session yesterday. The EV maker extends gains after second quarter deliveries beat estimates. More on that next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Kayleigh Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Minutes into the equity market session this Wednesday the 3rd, and European equities are tracking a little bit higher this morning. I think there's a few kind of interesting elements to what we're seeing in the market this morning. Keep an eye on what's happening with Rheinmetall. That stock story definitely up on a Handelsblatt report suggesting the Italians are about to buy a lot of tanks from the German manufacturer. That is a story for the DAX, but broadly we're up kind of 5, 6, 7 tenths of 1%. There's a legacy story coming out of the United States, which is interesting as well, and a lot of that driven in some ways by Tesla. Tesla shares jumping, deliveries for the second quarter beating estimates. Estimates weren't that particularly high. Let's kind of park that one as well. Option traders are betting the EV makers. Recent rally has more to run, and it's been a decent rally over the last few days. One of the longest rallies we've seen for Tesla in recent memory. Let's bring in our transport reporter from Hong Kong, Danny Lee. Danny, expectations weren't particularly high. The numbers were better, but are they really that good?
Yeah, the numbers were better by not that much, but given everything that has happened to Tesla over the recent months and the kind of downward pressure that we saw on the potential sales. This is a good number overall. And when you look deeper into the numbers, you look at some of its other businesses, such as energy storage, that really outperformed. And so therefore, when you do see something fundamental like the EV business kind of failing or slipping up, you do have other sectors which are helping Tesla regain some momentum. And we'll see more of that in a couple of weeks when it releases its second quarter earnings. But everyone is looking out for August 8th, and when Elon Musk has more to say about the robotaxi and what exactly the rollout and the timeline is of that, because right now Tesla has a frankly stale lineup, and that's always been the criticism, and so therefore what happens next month is going to be very key to just how much the share price has to run in terms of room to grow.
Yeah. Danny, I was reading a piece this morning by our colleague Liam Denning, an opinion piece that says only Musk's robotaxi can save Tesla investors now. Is that a view widely shared, or is the robotaxi not quite so core?
I think the robotaxi is very much fundamental, along with this AI story that Tesla continues to champion. So, more details, more kind of concrete timelines of what this robotaxi will do and at what scale and how quickly is going to be very important, because this is all going to feed into the share price and potentially the earnings. But the criticism has always been Tesla is acting too slowly to react to the broader market.
So, Danny, let's broaden this conversation out. Provisional tariffs between Europe on Chinese EVs kicks in tomorrow. What does that mean? Is there talks going on? Walk us through what we need to know around that story.
Yeah, there is talk still going on, and whether we see some of the tariffs that were kind of guided towards from last month published as they are, that wouldn't be a surprise. Do we see anything at all would be another question. That would be a surprise if we don't see any tariffs being implemented. But the key thing here, there will be an implementation, but no money changes hands here. We've got to wait another 4 months before the tariffs really kick into effect when it comes to the real cost mounting onto automakers. But as we wait at the moment, China is still putting a lot of pressure on certain countries, namely Germany, who has a lot to lose in these kind of EV tariff wars, that China really wants someone like Germany to really use their weight to try and convince the European Union to step back from what would be punitive tariffs. And China still has its own kind of retaliatory measures that it could still wield out on sectors such as cars with large engines, which would directly affect Germany, could do so for dairy, agriculture, pork. So it's really a wait and see until what kind of measures that the Europe and China would both be happy with.
All right, our transfer reporter Danny Lee walking us through what those dynamics of the EV space look like, and broadly between China and the read-through into Germany. That's likely something we're going to be discussing. You do not want to miss our exclusive interview, by the way. We're going to switch topics with Jose Manuel Campa, the chairman of European Banking Authority, coming up next as he discusses their spring report. That conversation coming up. Stick with us. This is Bloomberg.
In tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is the opening trade. We're 30 minutes into today's session. There's a lot of individual movers, but I think net what you need to know is you are seeing green on the screen across the major indices. When you look at the breakdown of the Stock 600, to me at least, it is a tale of two heavyweights. ASML on one hand, really taking their lead from that tech rally in the States overnight. And then on the other hand, Novo Nordisk, as we kind of pulling it down. A lot of that perhaps concerning around Biden's comments around the Wegovy and Ozempic pricing. So those are just two stories that we're keeping an eye on. And we've also got our eye on the bank story as well.
Yeah, we do. And I noticed the BE Semiconductor is the best performing, and that takes us to the tech story you were referencing. But on to banks, the European Banking Authority has called for caution amid rising geopolitical risks. In the spring report from the EBA, they also highlight elevated economic and interest rate uncertainty for the banking sector. Joining us now for an exclusive interview is Jose Manuel Camper, the chairman of the European Banking Authority. Very nice to have you with us. Thank you for coming to speak to us here on set in London. So I wanted to, we've got lots to discuss. Let's go to the CRE, the commercial real estate market first, if we could, and risks there. Is it your sense that we will start to see losses crystallise for the banking sector in this space as deal volumes pick up? Some people are talking about we're seeing more deal volume, and as a result, we're going to get some price discovery.
Yeah, I think that's absolutely the case. In fact, I would say that we should not expect that that's already happening. You know, in our report, we highlight that the increase of non-performing loans on that part of the portfolio of the banks has been the largest, and it's likely to continue to increase going forward. We think that this is a trend that is not going to be in the short term. It's likely to be also medium term because there are structural changes in the commercial real estate market. Commercial real estate is a very broad definition. It includes many different things, so you have to be a bit careful. But in general, you know, we would expect that there is price discovery and price alignment in the medium term.
So you expect that to continue. Is it in danger of worsening? Because some top colleagues tell me that perhaps the banks are selling some of their better commercial real estate assets first, and that perhaps doesn't do too much damage to valuations and balance sheets. But as we get through this process, they'll have to sell some of the other stuff that it doesn't look so good. Would that be your expectations from dealing with the banking sector?
That's likely. It's likely that will evolve. Again, it's a diverse sector, so it's hard to predict one by one. But one thing that's characteristic of commercial real estate is that they tend to be bullet loans, so that most of the principal gets paid at the end, while in the interim they're just paying interest. So most of that restructure will take place as that loan becomes due at the end of the period, and it has to be repaid, and the inability of that commercial real estate agency to repay, that would lead to probably sales or restructuring. That's why I said before it's likely to play out throughout the middle term.
Okay, tick. We've done one of the three big risks that we need to talk about. Anna's done the CRE risk. I want to talk about what's happening with the private lending story. Bank of England Financial Stability Report out last week, and this is a quote from it. Vulnerabilities in the private equity ecosystem could amplify shocks and disrupt the stable provision of finance to the real economy. The Bank of England is a little concerned about what it doesn't know, really, I think, about what is happening when it comes to banks lending into the private markets and the level of activity that is taking place here. All of this ultimately to a group of companies that are highly leveraged and quite vulnerable. What do you not know at this point about what is happening here? Because it seems that it's the lack of transparency that I think is causing regulators concerns.
I think you're right. I mean, first, let's start with what we do know. We know that the private credit market has been growing a lot over the last 5 to 10 years. That's a fact. We know also that part of that growth has been driven probably by increased regulation in the banking sectors that have been transmitted there. We do know, and we're publishing our report now because we focus on this area as a key area of concern, what are the direct links between the banks and the non-banks. So we do know, for instance, that it's about 10% of the asset portfolios and 10% of the liability portfolios of the banks that are engaging with these non-bank financial institutions. To some extent, it's normal. They're a big part of the economy, the financial institutions, so that's okay. The part that we don't know is what goes on afterwards from that direct link between the bank and the non-bank, how the non-banks are interacting with other non-bank financial institutions or ultimately with the ultimate borrowers.
Yeah.
And that's the part that I think we need to understand better and have more discovery. We've been calling for, enhancing the reporting requirements, the disclosure requirements of this part of the sector, just to have a better assessment. I think the Financial Stability Board, beyond just the banking sector, looking at the global area and all financial institutions, will also start working on this. And I think it's a first step that we need to find out. We need to find out how the interlinkages work.
We are effectively we're seeing a lot of financial engineering in this space at the moment. And the reason for it is that I think private equity, private credit, struggling to make the returns that it normally would. So they're kind of figuring out new ways and new ways of generating the returns that they need. Financial engineering generally creates more instability. Would you say that instability is growing? Is that a reasonable thing to assume, that as this process unfolds, it becomes more unstable?
Yeah, it's hard to know that it's growing because I said we don't know the linkages.
Fair enough.
But it's important to at least assess and reassure ourselves that financial stability is not growing because, as you said, in the past we have had the experiences in which financial engineering, financial innovation led to apparently what was more risk diversification, but ended up being actually really being vulnerabilities for systemic risk. And that's the part that we need to assess.
Does the perhaps backlog of the private capital markets that Guy was just referring to, it feels like the solution at the moment is just have capital markets activity pick up, right? The buyout exit should be this easy solution. Would that relieve you of some of the concerns around the private markets if you saw a pickup in something like M&A activity or IPO?
Well, if it was more transparent, we had a better understanding of how that private credit is being allocated because there's more information. Let's say if they go through a acquisition of a publicly traded company that requires information provision, more disclosure, that would be helpful over time. I think so.
And then put that into the context of things like the Basel III rules, for example. The U.S. is really pulling back on some of the more strict banking regulations that they had or were attempting to have. Jamie Dimon, of course, leading the charge on trying to pull those back and successfully doing so. How does Europe catch up to that? How does Europe compete when there's that deregulation element in the States?
Well, actually, so far, the message that we have received from the United States is that they're still willing to continue to be loyal to Basel, to implement Basel in a faithful manner. They're just going through the process, trying to work on the details and the timing when they're going to do that. In fact, what we have done in the European Union, the European Commission announced this 2 weeks ago, is we have delayed the implementation of one part of the Basel package, which is called the Fundamental Review of the Trading Book, which is basically the part that affects market risk, which is the one that's probably more linked to global markets, to level playing field. We have delayed that for a year until now, January 2026, on the expectation that there will be a coordinated and timely implementation by all major jurisdictions.
Isn't that a risk, though? The United States can do that because the economy is roaring, because the banks are resilient, the consumer is resilient. You can't say that about Europe. Does that put Europe more at risk that they've delayed that cushion that's needed in some of the European banks?
Well, our assessment for the risk assessment reports is that the banks at this stage are solid. They have good profitability, European banks. They have low levels of capital, good levels of liquidity. So that's a good starting basis. It is true that it's a reform that enhances the prudential requirements of the banks in this part of market risk, and we want it to be implemented as soon as possible. So in that sense, we're moving to a better system. So that's enhancing this sustainability of the system overall. But I would not say that at the current circumstances, we're really putting the bank system at risk. We're just making sure that we're facilitating that smooth transition while preserving open global financial markets.
What is the concern around geopolitics specifically? Because we can all see how life might become more difficult for European banks doing business in Asia. We can all see how perhaps the rise of right-wing populists might lead to more calls for taxation on the sector, for example. Yeah. Where is your focus when it comes to geopolitical trends?
Well, as you said, it's very hard. Geopolitical trends, they come from many different varieties and have many different impacts on the economy. So what we put in the report is this has been clearly highlighted, increased. Banks need to be aware of it. They need to act on it. To us, this implies more that the way they think about their risk assessment has to change a little bit. They need to think more in terms of potential scenarios that may happen. So pick any one of those that you chose and think about how that will filter into their business model going forward. And as a result, what are the actions that they will need to take? It's no longer thinking so much about what's happened to GDP growth and employment or regular economic variables and how you manage that, but more maybe you need to think about inorganic actions or things of that sort.
Because you put this high up on the report. This is the biggest risk you mentioned on the report.
Picking up on what Anna said, though, Europe feels like it's being more fragmented. You talk about this. Does the regulation Europe needs for its banking sector feel further away because what's happening in France? Does it feel further away because of the fragmentation that Anna's talking about? Does what Europe needs to happen next seem more difficult to you today before we go into the second round of the French election?
Well, what's more difficult was the challenge, as you said forward, as you said before, is that, the trends in politics tend to lead us within Europe to the possibility that there is a less Europe project going forward. And that's obviously in contradiction with keeping.
You think the banking sector needs more Europe?
Of course. Of course. One of the crucial challenges that we have, as you know, since we created the banking union of the last 10 years, is that although there's been this creation of the banking union, the degree of cross-border banking activity has not been increasing, and that's a challenge.
That's something that we've heard from Emmanuel Macron as well, in terms of encouraging that kind of consolidation. And yet, the inclination is still to do more domestic deals. We're seeing that, I think, most recently with BBVA and the bid for Sabadell, for example. But there is still that inclination to stay domestic. How do you incentivize those kind of cross-border deals?
Well, we need to make the underlying regulation, the underlying economics work for the banks. I believe that the
banks have pushed back on that.
I agree, and it's the message that I hear from the banks as well. It's a source of concern for us, and a sort, if I might say, an encouragement for future work, because we want to make sure that the system in the single market, there is the ability to be able to do cross-border banking, to diversify risks across the whole economy, and to provide funding in different countries.
But that's getting harder. You don't see that getting easier. You see that getting harder.
I would not say it's getting harder, but it's not getting easier.
The politics, do you think okay, so
the politics, yes. The politics is likely to get harder.
Okay.
But if I might say, we went through a process of European elections 4 weeks ago, in which the expectations was that this was going to become much, much harder. We ended up with a European Parliament that still continues to be in a majority of the political groups in a pro-European stand.
So that's the politics, but there's an economic component to this as well. It's the transmission of the interest rate mechanism, right? This is the concern in Spain, that it can't go fast enough. If there is more consolidation, you can't get it to lower interest rates to the savers fast enough. Does that more fall on the ECB's transmission mechanism than the banks themselves?
Well, there's a challenge for the ECB. They need to assess how the transmission mechanism works in the different countries, given the different market structure. That's absolutely true, and they look at that carefully, I think. And they assess that. The evidence that they provide is that transmission mechanism still works well. And of course, in the deal that you mentioned of BBVA Sabadell, there's a competition aspect that's up to the competition authorities that they need to assess, and they haven't come forward with a report yet.
That was really interesting. Thank you very much indeed for stopping by. I think we went through all of the major risk factors, and we'll throw in some politics as well. I guess you flagged the geopolitics up there right at the top. Jose Manuel Campa, thank you very much indeed, the chairman of the European Banking Authority. Talking of politics, final day of campaigning ahead of the UK general election, which feels, compared with everybody else's elections right now, a bit of a snooze fest. But maybe there's some interesting aspects of this story that we are not focusing on. Let's talk about how business is going to see this election. Sam Gyimah, a former Conservative government minister who later joined the Liberal Democrats and then joined the City of London, is going to be joining us next. This is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around prevention.
For us is obviously looking at how do we maximize trade with the European Union in a sensible way, how do we make sure that we keep our population, we essentially have sovereignty for the British people. That is really, really important, and we will not compromise on that. But do we want to have great trade relationships with Europe? Absolutely. By the way, we also want to continue to have great trading relationships with, the United States and a lot of other countries too.
Do you think having a strict immigration policy is inflationary?
I think it's, again, all about how you implement it. That's my position. So number one, if you look at Britain, it has we're sixth in the world in GDP. We're 21st in the world in terms of GDP per capita, right? And I would argue GDP per capita is actually a reasonably good bellwether for quality of life for people in this country. No one knows better than I the contribution that immigrants can make to this country. My parents came here 40 years ago, contributed half a century of service to the NHS. I've done my part as well to create jobs and pay taxes. But again, it's about numbers. And it's about making sure that we have, number one, a secure border. If you don't have a secure border, you actually don't have a coherent immigration policy because you're actually unable to implement it. Secondly, it's working out, okay, how do we ensure that we are able to address some of these huge problems the country has, which are driven in no small part, not exclusively, but in no small part by exploding demand for those services.
Youssef, Reform Party UK donor and founder of Velocity Black, speaking to Bloomberg. Let's talk a little bit more about this, because in some ways this immigration story is one that is represented in a number of different political narratives that we're discussing at the moment. The United States, you could argue it's been a huge force in terms of the growth story that we've seen out of the United States. Here in the UK, it's becoming very divisive. Can you grow the UK economy without immigration is a key concern, I think, for a lot of people right now. And the UK, in some ways, is a bit of a microcosm. Post-Brexit, have we seen a tighter labour market here because of that lack of immigration that has caused problems? And France grappling with the same challenges as well.
Yes, and the great resignation, the great quit post-pandemic, still a feature of the labour markets, of course, as well. Yep. And the extent to which you turn to immigration to alleviate that pressure on the labour market is going to be one that runs into politics. Interesting to think how different communities, different groups vote in these forthcoming elections, though, because on the one hand, immigration rhetoric is front and centre, certainly here in the UK, and has been to some degree in the US. But then there's tensions within some communities around the Middle East and politics in the Middle East, and that has an impact, certainly, on the way that certain communities will vote and their enthusiasm for, say, the Democrats in the United States or for the Labour Party here in the UK. So this is going to be quite a nuanced story, perhaps.
You talk about the UK, the US. It's, of course, a theme in France, as you mentioned as well. It's also a theme in the Netherlands. And this is the conversation we started off at the start of the program with Sandra Flippen talking about the fact that ASML is actively petitioned the government to say reduce your immigration or lax your immigration policy a little bit so we can hire the talent that we need to keep it going. That, even though it's a very Dutch story, suddenly becomes a broader story because that, to your point, is inflation. That's the very first question you asked your guest.
It's something that's been represented in the United States as well. Big tech, therefore, in the US has been seeking to bring in talent. And has brought in a lot of talent via the visa system, and that may change under a Trump administration.
Right. And this is something that, to your point, that the Fed is talking about as well, right? Is this something you factor into the jobs market? How quickly does that data show up?
Okay, talking of data, let's have a quick rundown of what we're looking ahead to today. Euro area PPI, German 10-year auction, 5 billion euros coming in that format. US initial jobless claims in focus, Fed meeting minutes in focus as well. And worth pointing out, Guy, that some of these data points are going to come a little earlier in the week than we would have expected because, of course, 4th of July is voting day here, but it's a holiday in the United States.
It's the end of the week. Today is the end of the week. You've got elections coming up. You've got the US closed. You've got light liquidity on Friday. The potential for problems on Friday, I think, could be quite significant. You get a big kind of number out of payrolls. How could that affect the narrative? You get people positioning around the French election without the liquidity maybe to do so. How could that affect the market? So I think Friday's going to be a really interesting session. It's just not going to be it's going to be an abnormal session. So today's the kind of the US markets are closing early today, so maybe not even today is the last kind of full session of the week, I would argue.
Well, don't leave just yet. We need you for the next 2 days.
I'm here. I'm looking forward to the next 2 days.
He's here. The euro-dollar story, I think, is so fascinating going into the end of the week. On Friday, to your point, on the one hand, you've got the French elections, which, of course, is going to be, do you cash out of the euro in advance of that? Do you dive in on kind of the expectation of gridlock, perhaps? On the other side of that trade, you've got the payrolls report, you've got the data in the States, and then whatever the Biden-Trump fallout looks like in terms of polling, whether that shows up in positioning for the dollar as well. To me, it's the euro-dollar that I've got my eye on.
Yeah, and you were asking Mark Gudmore a little earlier about this as well, weren't you, and what his expectation. I think it is going to be fascinating the way all of this falls in quite a quiet market, or will people decide that this data point is too important and they'll stick around for it? I don't know. Is it a jobs report that has that kind of elevated status?
So Dan Curtis, who kind of crunches our numbers for us and makes us look smart, ran the numbers on this yesterday for me. The payrolls number, when it falls on this date, comes with lighter liquidity. So we should expect lighter liquidity. We are probably going to see lighter liquidity. We're going to see less volume going through the market. Lighter liquidity can cause trouble, and so historically, that's what you would normally expect. So Friday could be a bumpy ride.
I'm gonna broaden it out here. It's not just Friday we're talking about because so much of the geopolitical risk is happening. We're heading into the summer session. So I wonder how much of the real actual positioning story is kicked out into September, for example, specifically in this region, given that light liquidity story. And does that show up in the markets as green on the screen? Is it just autopilot all day long?
Okay, I think we're going to return to our UK conversation.
Let's do it.
We are going to be talking shortly to somebody who knows a thing or two about how politics in the UK works, how the business community is going to be looking ahead to the election that takes place tomorrow. I'm very pleased to say that we're joined now by Sam Gyimah, former UK government minister, non-executive director of Goldman Sachs International, CEO of the international advisory firm SG. And Sam, very nice to speak to you. The last time I spoke to you years ago on the green outside the Houses of Parliament, so nice to see you. We haven't got long for our conversation, so let's jump right in. Are you expecting a supermajority, if we can use that word advisedly, if that means much in the UK? What difference will that make to what Labour intends to do?
I think we're going to see a very significant majority. Looking at the polls now, it's even questionable whether the Conservatives will be the main opposition party. That is a sea change. That will be a sea change in British politics. What would mean is that obviously from a business point of view, you would have a party with a secure majority that is not in hock to the extremes of the party. But it would also mean the centre of British politics will move. Most business people are focused on the fact that Labour's manifesto is in many ways very close to the Conservative Party manifesto. But when you get into power, you can move the centre. And when you have that kind of majority, I expect to see that. So for an example, on an issue like Europe, we will be seeing probably the most pro-European government that we've had in the UK in a very long time. And that could mean a very different tone. Starmer's going to be going to the EU. I mean, he's got this summit at Blenheim coming up in 2 weeks' time. He's got NATO. He's going to have the opportunity to reset a lot of these relationships
Does the
very
size of the
quickly.
majority impact how Starmer deals with Europe? If he gets a big majority, do you think he can move more aggressively on that, more quickly on that?
I think his style is clearly to be incrementalist, but in terms of the tone, we've been through a period in the last few years where anything that comes out of the EU under the Conservative government has to be treated with deep skepticism and suspicion. That will not be the case with Starmer. Certainly on defence and security cooperation, I think he will be like to be a more front-footed than maybe the Conservatives would have been. And in very specific areas where there is an open door, I think he'll be going for it.
Is it all about just those specific areas, though? I mean, obviously they've said they've ruled out single market and customs union and the like. And even on those specific areas, is the EU in the mood to listen? They've got enough issues holding things together at the moment. It's a changed EU from the one that Boris Johnson was negotiating with.
I think I can talk about how I see the politics in the UK, and I think it'll be very hard, given that growth is something that Starmer has trumpeted a lot, to see Labour MPs lashing themselves to the detail of Boris Johnson's Brexit deal if they see that as holding growth back. I think there will be a huge pressure, wherever Starmer is coming from his own backbenchers, to do what is needed to do to get growth going. And if you want to get growth going, there are lots of things you need to look at, lots of difficult things that Starmer will have to address, but certainly the EU part is a key part of it.
Very quickly, I'm going to put you on the spot here. Does that come with political pushback, though? If you do start to see the most pro-European government, does that have kind of a ripple effect in the long run?
I think it's a question of tone and being pragmatic and sensible. I don't think Starmer, from what we've seen of him, is suddenly going to say, let's litigate the 2016 referendum. But where I can see consequences long-term is, for example, on migration. That if you have a situation, if you have a pro-migration government, if the Liberal Democrats have sort of 65 seats, they are also pro-migration. Migration is about net migration 600,000. You can see that down the line, if that isn't really brought under control, the resurgent Conservative Party becomes sort of the English nationalist anti-migration party. That is a scenario that is really possible, and it's kind of what you've seen in France. What didn't seem possible, under Marine Le Pen suddenly seems possible. So that's where I can see effects down the line. But in terms of Europe specifically, I think the public is probably ahead of where the politicians are in terms of needing some change.
Great to see you, Sam. Thanks for stopping by to see us. We really appreciate it. Time beats Sam Gima, former UK government minister and CEO of SG. And so that's it. We wrap the programme up. Next stop, Anna, is the UK election. We'll be watching that tomorrow.
Yeah, absolutely. That is it for the opening trade. The pulse is up next. We leave you with European equity markets making modest gains, up by 0.4%, reflecting on those gains in the United States, in the wider tech sector yesterday, even if not NVIDIA. And we work our way towards the 4th of July. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
authorities.
Could face bigger challenges. Britain's next.
It was going to keep Green World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
French bonds rise as political parties pull candidates in an attempt to keep the right to the far right from power ahead of the final round of legislative elections. It's a final countdown to the UK's election, with polls pointing to a landslide victory for the opposition Labour Party. We'll break down the potential outcomes and what they could mean for the economy in a special edition of Bloomberg UK. Plus, European stocks gain after US equities hit new highs. As Jay Powell says, it appears that US inflation is returning to a downward path. So let's take a look at the European markets map. We do have quite a lot of data, well, this week. Today we have a bit of data in Europe. We have PMIs, and then, of course, the big one is the jobs report on Friday. It'll be interesting to see volumes on Friday, given the fact that it is also a bank holiday. Well, not a bank holiday. It's the 4th of July on Thursday. This is a picture for the S&P 500 futures. You can see 5,564. We had record highs for some of these indices. The U.S. 10-year yield 4.43, and then the France-Germany spread not as wide as it was just a week ago. You can see Brent crude 86.6, actually oil at a 2-month high. So the pulse starts now.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
So more than 200 candidates have withdrawn from a 3-way runoff ahead of France's second-round election on Sunday. Well, this as other parties seek to avoid splitting the vote against the far-right National Rally. Let's get more from Bloomberg. Caroline Conan now. Caroline, how have the parties been maneuvering ahead of the runoff?
There's been a lot of political bargaining over the past few days, and as you were mentioning, in 2/3 of this 3-way contest that was supposed to happen in the runoff, you have candidates who came third, who actually decided to pull out, to withdraw from the race in order to block the National Rally from gaining an outright majority. That's what we used to call the Republican Front. That's what happened, for example, in 2017, in 2022, when you had President Macron facing Marine Le Pen in the presidential elections. We'll see what that creates. There was one poll showing that the National Rally could still get an outright majority, but now the markets have been calming down and are saying that this scenario actually is a bit more remote right now. Now, the question is, if the National Rally gets, for example, 260 seats and is just 15 or 20 lawmakers away from an outright majority, is Jordan Bardella becoming prime minister? Before the first round, he was saying, no, only if I become if I get an outright majority. Now Marine Le Pen is saying that perhaps they will try to grab 15 or 20 lawmakers from other parties, perhaps from the Republicans, and still take the role of prime minister.
All right, Caroline, thank you so much. Caroline Conan there with the very latest on the French election. Of course, the second round of legislatives is on Sunday. Now let's get more from Freya Beamish, Chief Economist at TS Lombard, and Bloomberg's Justina Lee. So thank you both for joining us. Justina, let's kick off with you. I mean, the markets have been quite volatile. Is there an expectation that markets then kind of temper down once we actually have the result?
Yeah, and I think it kind of depends on what the results are. I mean, as the way it looks, it seems like people would be in for a shock if kind of Le Pen kind of does better than expected at this stage. And I think anyhow, it's still the case that, you know, markets want a hung parliament, but kind of things are not going to be the same as what it was. And I think that's what you're seeing in the markets, and that kind of has implications for European markets as a whole.
Freya, what's your take right now on the French elections? It seems that half the people we speak to, and a lot of them won't actually go on the record, but half of the people are worried about, you know, protests of people not working, going to the streets, if there was a far right in power, and others are worried about fiscal spending. Which one is it?
In terms of the immediate market reaction, we have to think about whether there's a hung parliament or not. I'm not convinced that markets have got it right with regards to the implications of that. In terms of the wider context, it is very threatening to have this type of a party at the heart of Europe. That is obviously much harder to price in the immediate future. So I'll focus on that immediate reaction, which I think markets did go through a little bit of a relief rally, which under normal circumstances makes complete sense. You don't want politicians to be able to just do whatever they want. I think in the context of Europe, it's a little bit more complicated in the sense that for the ECB to feel confident, for the ECB to really kind of be that backstop that it needs to be, use the TPI, calm down repo markets, use the blueprint of the Bank of England in the Truss Kwarteng debacle in the gilts crisis. For the ECB to do that, it's a lot easier if there's a clear majority, in the sense that a majority would actually be able to work with the European Commission under the excessive deficit procedure and sign a deal. Until you have that kind of clarity, there is more of a question mark on what the ECB can do. I think when push comes to shove, the ECB probably would move in unless anything massively egregious is being said. But at the moment, it seems as though Rassemblement National is taking a leaf out of Meloni's book, looking at the Italian blueprint, in the sense that they seem to think that markets are a big enough stick for them to be sensible.
But Freya,
and when
you also argue. Yeah, you also argue that actually the repricing of the fiscal policy, I guess, in France is probably long overdue. So does it mean, what does it mean for your take on other European countries? Do we need to look at the fiscal complex and say, look, given the rules that we have here, this is where they should be?
Yeah, I think in terms of the broader European fiscal effort, I still have some confidence that we can make some progress there, particularly benefiting France and Germany and Italy, as it happens, in the sense of moving more towards a wider funding of defense spending, of energy security, and those big countries actually benefit from that, as opposed to what happened in the NGU, where it was more to do with kind of economic underperformance, and so those countries didn't benefit as much. So that's the kind of the positive there. Specifically with regards to France, I'm more worried about debt sustainability there because it can't be a high-pressure economy. I like high-pressure economies such as the US, such as the UK with regards to debt sustainability, because I think that keeps debt ratios at bay. But because France has such a high private debt ratio, it's hard for the economy really to sustain strong growth amid high interest rates. And so your debt sustainability, your debt ratios is more of a question with regards to the government debt ratio.
Justina, we were also in Sintra, Portugal, yesterday trying to speak to ECB officials, and I asked, of course, the chief economist and others about whether the ECB would intervene, whether if the spread between Germany and France widened further. I mean, do you think at some point they could intervene?
Oh, wow. I mean, I've got to Josh that question here, and you can kind of see that it's been kind of a pretty political kind of debate as well, with SocGen actually kind of weighing in yesterday, because earlier the German minister kind of tried to argue against that. And so I think the mechanism is there, and I think, but it's going to be a pretty unprecedented use, given that I don't think anyone kind of ever thought this could be kind of applied to French bonds.
We also heard from Jay Powell yesterday, Justina, and we're looking at a lot of the S&P 500, for example, ending above 5,500 for the first time in its history. What's supporting these equities in the US?
Yeah, it's kind of funny. I think equities are still kind of enjoying this Goldilocks, where when they see a bit of bad news from the economy, it's not too bad, and they can kind of enjoy the rate cut narrative. And that's kind of what Jerome Powell kind of delivered yesterday. I mean, he really acknowledged the progress that we've made on the disinflation front. But I think it's interesting that he also said, we can take the time to get this right. And I think that just shows he wants to see more evidence that inflation is indeed cooling. And he thinks there's no time to panic because the job market is still looking pretty healthy.
Yeah, here's Jay Powell.
We want to be more confident that inflation is moving sustainably down toward 2% before we start the process of reducing how tight our policy is, of loosening policy. Frankly, because the U.S. economy is strong and the labor market is strong, we have the ability to take our time and get this right, and that's what we're planning to do.
So, Freya, when you look at what we heard from, not only Christine Lagarde, but Jay Powell there, for me, it felt like they were saying actually higher for longer. So we've made progress, but we don't really know what the inflation complex looks like. How did you interpret those comments?
Yeah, I think there's something to that, but I think they also will probably see in the data that the inflation is moving in the direction that they want. There's a couple of things that are going in the wrong direction. Shipping costs have picked up again. And that feeds through to some extent, but it doesn't feed through to any great extent, particularly in the European case. In the US case, maybe there's a little bit more argument for that. But I think the broad trajectory continues to be towards something manageable. Let's say in the US, 3% and below. In Europe, probably undershooting the target. So Europe can afford to move much more quickly here, and probably should have moved much more quickly already. And I think what we'll see in the US case is that inflation will come down to a rate that is seen as manageable and within range of the target. And perhaps actually when we look at the jobs report, I'm not saying specifically about Friday's jobs report, but over the next kind of few months or so, I would say probably downside surprises is what's underpriced, in the sense that people stuck their neck out last year with regards to the recession call, and it didn't come through. And we do still see some kind of evidence of slowing in the US jobs market there that could come through over the next few months. So I think by September there is going to be a clear signal that the Fed can cut as well.
Freya, I mean, tomorrow's UK election, of course, here in the UK, and a lot of the focus will be on, it looks like Labour has it, if you look at the polls, by a landslide, but then they have a huge fiscal cliff. I mean, there's huge concerns about how they fund some of their policies. What's your take on the UK?
Yeah, if we take a really narrow, kind of sensible, economists are just glorified accountants approach, then we should be thinking, oh, well, how are they going to make their pledges? Or they haven't pledged a great deal. There's a lot that's still left to question, which I think is a good thing at this stage in the game. How are they going to make their kind of pledges stack up? Are they going to cut spending, or are they going to raise taxes? They've left themselves a little bit of wiggle room with regards to kind of capital gains tax, but my bet is actually that growth does come through to some degree. And that's, again, because the UK is a high pressure economy. There's a tight labor market. And I think the lesson of the 2010s is that when there's no pressure, then you don't get productivity growth. And I think the broader lesson of history is that when you have a tight labor market and you have an ability of businesses to respond to that in a world that is not hyper-globalized, i.e. they won't just offshore, that they will start to invest domestically, and that will help capex growth, and that will help productivity growth. So I think that helps them out. I think the Labour Party probably, even though it has tied itself down to a frankly ridiculous fiscal rule with regard to the 5-year outlook, it can probably shift the culture around how those fiscal rules operate, if you read between the lines of the May's lecture, for instance.
Justina, how are you expecting markets to behave on the back of the election? I mean, it seems that a lot of it is probably already priced in.
Yeah, I mean, I think generally people are not expecting much of a reaction. I mean, partly because this is a center-left kind of government who doesn't have a lot of fiscal room to do anything bold anyway. But I think if you kind of look beneath the surface, I mean, a lot of strategists have talked about, the impact on home builders, for instance. I mean, Labour has talked about, easing planning restrictions. There might be an impact on, like, the takeover of Royal Mail's owner, more specifically. Or kind of maybe people will just be happy to kind of have a bit of stability and maybe a government that is a bit more friendly toward Europe and kind of wants to get a better kind of trade deal with Europe. And I think we have heard some positive noise that at the very least, the UK is now looking like an island of stability in Europe. You're hearing that a lot. And we haven't heard that for a while now. So.
We'll take that, an island of stability. Thank you so much, Justina and Freya. Freya Beamish, Chief Economist at TS Lombard and Bloomberg's Justina Lee. Now, coming up, the Finnish President, Alexander Stubb, says China could solve the war in Ukraine with just one phone call. He spoke exclusively to Bloomberg, and we'll bring you that conversation next. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
The Finnish president, Alexander Stubb, says China should do the right thing and help broker peace in Ukraine. While speaking exclusively to Bloomberg, he said that Russia is so dependent on Beijing that President Xi could solve the crisis with just one phone call.
In the beginning of the war, I think China was sitting on the fence. It was sort of looking around, trying to understand what was happening and why Putin was doing it and what the ramifications are for itself. But as time has progressed, and we're now almost 2.5 years into the war, China has started to provide Russia with different types of aid, not direct military aid, but issues linked to energy, sometimes even dual use of goods. I argue that Russia is so dependent on China right now that one phone call from President Xi Jinping would solve this crisis. If he were to say, time to start negotiating peace, Russia would be forced to do that. They would have no other choice.
How likely do you think that that phone call would be made?
I don't know, but I call upon China to do that. If China is genuinely interested in peace, if China is genuinely interested in harmonious relations between nation states, it cannot allow a country like Russia to drive an imperial, at the end of the day, aggressive and colonial war against a independent nation state. It needs to protect the international rules which are linked to territorial integrity and sovereignty. That is the right thing to do, and that would also show leadership from China. And I think it would get a lot of goodwill, not only from the global south, but also from most countries in the global west, were it to be taking a stronger role in ending this war.
Well, that was the Finnish President Alexander Stubb speaking exclusively to Bloomberg. Now, the U.S. ambassador to NATO says there are concerns over deepening ties between China and Russia. In another exclusive interview, Julianne Smith told us NATO is working to expose China's efforts to support Putin's war in Ukraine.
China takes every effort, every chance it can get to argue that somehow it's a neutral player in this war in Ukraine. But in reality, the PRC is providing a long list of dual-use components, things like machine tools and microelectronics that are enabling Russia to pursue this war of aggression in Ukraine.
Well, coming up, Tesla beats estimates with a less drastic drop in EV sales, sending shares soaring. We'll bring you details next, and this is Bloomberg.
that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that...
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Well, Tesla has extended recent gains as deliveries for the second quarter were better than expected, than analysts were expecting. Well, joining us for more is Bloomberg's Craig Trudell, our autos czar. I love saying that. Now, Tesla stock jumping some 10% yesterday on these numbers. I mean, it's pretty remarkable. What made it?
Yeah, I mean, we're talking about a few thousand vehicles. You know, the expectation going into the print was a roughly 5.8% decline. Instead, they dropped by 4.8%. So, you know, definitely a clear beat here, but, you know, the number is still down. And this consensus, by the way, it had kind of dropped like a stone. It was 565,000 a year ago, and it had dropped to around 440,000. So, you know, we're talking about, you know, clearing a much lower bar, and yet this company added the equivalent of Porsche's market cap in a single day.
I mean, that's crazy. When you look at where they sold, I mean, I think some of the retail sales in China maybe did better than the U.S., but also they went to new markets. And so is this a good template of what earnings look like?
Yeah, I mean, I think, you know, in terms of looking ahead to earnings, you know, the energy storage deployments that were mentioned in yesterday's release maybe helps with that revenue, with sort of padding the fact that they're giving up some on the automotive side. But when you look at their segmentation of revenue, you know, they really just break it down by automotive, energy storage, and then services and other. Over the last few years, they've made more on you know, services for cars and merchandise and that sort of thing than they have on energy storage in terms of revenue. So, you know, just how much the energy storage business really starting to get momentum will offset the slippage in automotive, I think, is a real open question. And so the general sort of assumption is that revenue and earnings will continue to trend lower as a result of these numbers.
Craig, the Cybertruck. Where are we on the Cybertruck?
We still don't even have a breakout of Cybertruck within how they report their quarterly production and deliveries. It just gets thrown in with other models. So this is still kind of a two-trick pony. We still have a Model 3 and a Model Y really doing the heavy lifting, and you know, only around 20,000 units between the Cybertruck, Model S, and Model X. So I think some people are starting to wonder, you know, how much longer, you know, are Model S and Model X going to be around, given the fact that the two of those plus the Cybertruck, the volumes are so low at this point.
So interesting, Craig. Thank you so much, as always, our Craig Trudell. Now, on to some news involving the pharmaceutical sector now. And Sanofi's Dupixent has won clearance from European patients with a chronic lung disorder, creating another avenue of growth for the blockbuster drug. Now, shares in Novo Nordisk fell after the U.S. President Joe Biden continued his push for cheaper medicines by demanding the price cuts on their weight loss and diabetes drugs Ozempic and Wegovy. Meanwhile, there was mixed news for Eli Lilly. Its new Alzheimer drug received FDA approval in the U.S. Shares fell yesterday off the back of that push by President Biden to lower the cost of obesity drugs. Coming up on Bloomberg UK, we bring you the latest numbers from the polls and bookmakers on the last day of the election campaign. That's next, and this is Bloomberg.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to
bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Well, good morning, everyone, and welcome to a special edition of Bloomberg UK. I'm Francine Lacqua here in London. So it's the final day of campaigning before the UK general election. Labour has slipped to its worst rating in the Bloomberg poll of polls, with its lead over Rishi Sunak's governing Conservatives also hitting its lowest point of the campaign. Regardless, the opposition leader Keir Starmer remains on course to win the keys to 10 Downing Street in Thursday's vote. Now, let's discuss all of this with Camilla Cavendish, former head of the Downing Street Policy Unit under Conservative Prime Minister David Cameron, and Mike Brewer, interim chief executive of the Resolution Foundation, an independent think tank focused on improving the living standards for those on low to middle income. So thank you both for joining us. Camilla, let's start with you. What do you think this campaign is actually, what this election is about? It feels like more of a decision against the Tories than actually real conviction of what the country needs in terms of growth.
I think that's right. I think after 14 years, it was likely that the pendulum would swing anyway, but the dissatisfaction with the Conservatives is huge. I think a lot of people may not vote at all. Former Conservative voters are just have had it with that party, but as you say, there isn't necessarily such a positive surge of support for Labour. I think Keir Starmer has played it brilliantly because we've seen not only the last few years of the Conservatives self-sabotaging at every moment. You know, we had Partygate under Boris Johnson. We had Brexit, which is now a majority of the UK thinks was a mistake. Not only that, but the campaign, I'm afraid, you know, Rishi Sunak has stumbled again and again. And Keir Starmer has, all he's had to do, actually, is play it safe, look like a sensible, decent human being, and actually not given a huge amount of detail about policy. So I think if he had given a bit more detail, people might be feeling a little bit more positive about him. But the truth is there will be a lot of tactical voting and there will be a sigh of relief, I'm afraid, if there's a new government which offers some stability.
Yeah.
And your point on growth, I mean, what a lot of businesses and investors want now is political stability, which means hopefully 5 years of a government that doesn't keep changing prime minister and that has a clear industrial policy.
Yeah, and that's, you know, pro-business, which we seem to have with this Labour Party. Mike, what do you think this election is being voted on? And actually, what do people want to see in terms of their top priority and changes?
Well, the Conservatives have tried to make it a vote about tax cuts and Labour instead of offered us, I guess, a manifesto where they have a lot of ambitions to do things across a whole range of social and public policy, but maybe not too much detail. But I would want to focus on one exception where Labour, I think, have provided a great deal of detail, and that's in their agenda for the labour market, both what they say about the minimum wage, but also what they say about introducing new employment rights for workers and a fair deal in the social care sector. There's a great deal of crunch there, a great deal of detail there, with a set of proposals that could make a big difference to the working lives of several million voters. So I think
Mike, I mean, you seem to argue also that, you know, that actually there are very few people that are really engaged with the manifestos of the parties, that they're interested, of course, in the scandals. We had Gamblegate, we had Rishi Sunak leaving D-Day earlier. But apart from that, people haven't been following that closely the election policy, the manifestos. Is that fair?
Oh, that's definitely fair. Yes, we know that we know that from media tracking data in the last few weeks, that people have been more focused on the plight of that poor teenage boy in Tenerife than they have about the detail of the manifesto. But I think that's normal. I don't think there's anything different about this election from previous elections. People know that the economy has been struggling for the last 14 years, that living standards have hardly been growing. So there are big issues at stake. People can see the state of public services around them. I think people know there are issues at stake. But of course, the detail of the manifesto matters to wonks like us, to journalists and users. Right, you report it, but of course it never cuts through to everybody in the population.
So, Camilla, the Tories are working on taxes, and it sees Labour actually looking at the workplace. How will it change under Labour?
Well, I think Mike's point is really important, that actually he's right. One of the things that Labour have been clearest about for 2 years now is that they will bring in from day one a series of new employment rights. A lot of businesses have been very quiet in their response to this because they tend to, you know, they're seeing a Labour victory as inevitable and they haven't wanted to make a fuss about it. However, given that one of our only selling propositions now is still our flexible labour market compared to the rest of Europe, I think businesses are quite worried about unfair dismissal rights, for example, you know, the probationary periods. There's been a discussion about introducing the right to disconnect. There's a whole series of different things in there, some of which I agree with Mike would be really important for people in the gig economy, would lead to less insecure work. There are some other things where I fear we're going to see a rash of employment tribunals, and that is actually not going to be good for anybody, in my opinion.
Mike, your reaction to that? And also, again, we've seen some proposals for the fair pay agreement, for example, in social care, but a lot of the details have been lost. And as Camilla was saying, they haven't really been pushed to give firm answers, maybe because they're so far ahead in the polls.
Well, Labour have said that this is one of their priorities, and of course the first thing they will need to do is consult widely on the detail. And yes, it is true that some businesses will not be keen on paying their low-paid workers more or extending more rights to their workers. But I think the Labour government will be hoping that any discomfort among business will be sort of offset by the kind of stability, the reassurance, the kind of the sensible government is in charge now stability kind of line that Rachel Reeves is so keen to put out as well. But there are details to be worked out. There will inevitably be a discussion between trade unions who may want more rights for workers and businesses, some of whom may want less. I mean that's the messy business of government, and I think it's right that Labour comes to that in the next few months.
Fiscally, it's going to be a nightmare for whoever comes into power, frankly, because we've seen it called the worst economic and fiscal inheritance for any government, Camilla, since the war. Yeah. So, I mean, how much space do they have?
Well, this is the key question, Francine. I mean, the pandemic spending has hit every Western country, and Britain's debt to GDP ratio, I think, is at a 70-year high, as you say, since the war. There isn't much room to manoeuvre. Rachel Reeves is absolutely right to be focusing on growth. They're absolutely right to be seeking some sort of a new deal with Brussels, although it's not at all clear what Brussels would be willing to offer. I do think the Ukraine war and Britain's defence and military capability will help us in that respect. And I think we're seeing all sorts of changes right across Europe right now, with a series of incumbent governments either falling or under pressure. So that landscape is actually increasingly complicated. She's right to focus on growth, and she talks about a partnership with business. Yeah. That is what is not clear is whether Labour's view is that that's a sort of statist kind of partnership where they are offering the terms, or whether it's a genuine collaboration. And I think, as Mike said, I don't think any of that is set in stone yet. I actually think Rachel Reeves and Keir Starmer have been doing a lot of listening to big business. I don't know if they've had much time to listen to small business yet. And the next few months are going to be critical, I think, in determining the outlines of actually that strategy.
And Mike, again, if you look at the policies, I mean, the NHS, other public services, frankly, are in crisis. The growth is anemic. The tax burden is at a post-World War II high. So how much growth can actually the Labour Party deliver?
This is certainly not the economic or fiscal inheritance that any chancellor wants to get, right? I mean, growth has been terrible, and the next government will be really hitting hard against a set of fiscal rules, where everyone agreed we need to get public debt to fall. So the Labour's strategy so far has been to promise sort of as little as possible, and everyone is then crossing their fingers and hoping that either with a bit of stability that the growth returns, or we get lucky. But there's definitely equally well a chance that we could get unlucky. And the last set of forecasts on the public finances made by the Office of Budget Responsibility were thought to be quite optimistic. So there is equally well a chance that Labour could get unlucky when they were going to get into power. So it's very, very tough. What will they have to do if things turn out badly? They're either going to have to modify their debt rule, or they're going to have to find some taxes to put up, out of the ones they haven't yet ruled out.
Yeah. Camilla, what happens to the Conservative Party the day after the election?
I was just going to say, of course, on your chart, the thing we haven't talked about is the US. I mean, the bigger story here is obviously that Europe itself is falling way behind the US.
Yes.
So that is the context. It's very unclear what happens to the Conservatives the day after the election. I mean, the lowest share of vote I think the Conservatives have had is 160 seats under William Hague. And that is about the minimum you need to mount an effective opposition, because you have to have enough people to do the research, to be on select committees, to do the work of Parliament that means actually mounting a proper opposition. It seems possible that the Conservatives will go below 160. It's possible the Liberal Democrats will become the second largest party. And if that happens, I think the Liberal Democrats will tend to be attacking Labour from the left.
Yeah.
It's fascinating. Nigel Farage, as you know, is standing in Clacton for Reform. Reform might get maybe 3 MPs at the absolute most. But if Farage does win that seat, people are talking about whether he would become a future leader of the Conservative Party. Anything is possible. And I guess a great deal of this is dependent on what the makeup is of the actual MPs in Parliament. Jeremy Hunt, the Chancellor, may become the first incumbent chancellor to lose his seat. He's a moderate. There are a number of people like him. If they go, then the Conservatives will move further to the right. But again, some predictions are that actually some of the Brexiteers in the so-called red wall are likely to go, and that will shift the party back to the centre. So it's who knows?
All up in the air. That was Camilla, as always. Thank you so much. Camilla Cavendish, former head of the Downing Street Policy Unit, and Mike Brewer, interim chief executive of the Resolution Foundation. Coming up, how realistic are Labour's growth targets? We take a closer look at what a win for Keir Starmer would mean for the UK economy. That's next, and this is Bloomberg.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
We understand deeply how important it is to balance a budget. We're never going to put the British economy at risk. But yes, absolutely. You know, we do have an ambition to take corporation tax down to 15% over the course of 5 years, raise the threshold on VAT, abolish things like IR35. And by the way, a big one for us is actually to seize the opportunity that Brexit offered, which is to slash as much of the red tape as possible, to allow small and medium-sized businesses, especially, to operate, without, raising, as I said, the VAT threshold, getting rid of a lot of the red tape and the regulations. Again, as someone who ran my own business, and I know how a lot of these regulations, however well-intended, unfortunately, all they really do is slow people down, discourage growth, and line the pockets of lawyers.
This sounds remarkably similar to what Liz Truss was saying. And she got a very bad reaction from the bond market. Why is what you are suggesting not Truss really 2.0?
Really simple. What Liz Truss did, the thing that the markets did not like about that budget were simply that there were no sacrifices made on the spending side. So if you're going to, so essentially it wasn't the tax cuts that were the problem, it was the unfunded tax cuts. And one of the things that, again, Reform are very clear about is that it's not just about cutting taxes per se or anything like that. It's also about making sure that the British people get much better value for the taxes that they are actually paying. I mean, my immediate family work in the National Health Service, right? They're heroes to me. Obviously, the frontline NHS workers, I think, are amazing people. As I said in my speech, they work really hard for us. But almost everybody I speak to in the NHS will tell me day after day after day, how much waste there is, how much, frankly, incompetent administration that there is going on. And so it's not just, we are spending more money than ever in the NHS. Waiting lists are at all-time highs. So we can essentially make productivity something that is actually meaningful.
But you have the issue I think the markets would focus on would be a sequencing problem. You come in, you cut taxes. That's something that happens quickly. Reform of the NHS is something that happens slowly. And it's that duration mismatch that you've got that would cause the market concern. You can't guarantee
You can guarantee the former, you can guarantee the tax cuts, but you can't guarantee the latter, which is that you are going to be able to deliver the efficiencies. Many people have tried, very few have succeeded.
Yep. So I agree with that statement, right? You know, engaging with markets, understanding markets is actually really important. Frankly, Kwasi Kwarteng and Liz Truss actually didn't engage with markets, right? The attitude was markets will do what markets will do. Markets will actually look at, yes, the sequencing is issue, but markets will actually look at what your forecasts are. Markets will actually look at, you know, what is the budget going to be this year? Where are we trending? So again, I can tell you the people who are at the helm of making policy for reform are sophisticated. They understand that everything that we put forward as policy, not only will it make sense from a sequencing perspective, so we aren't blowing up big holes in the budget, we will also make sure that the forecasts are very clear about how we're going to be delivering the efficiencies and massive improvements in public services.
Well, that was Yusuf, Velocity Black founder and Reform UK donor, speaking to Bloomberg's Guy Johnson. Yusuf is among the political party donors we've been speaking to during the election campaign. So polls suggesting the Labour Party is set to win this week's election. For a closer look at what that win could actually mean for growth in the UK, we're joined by Dan Hansen, our chief UK economist for Bloomberg Economics, rather. Dan, a lot going on in my head there. When you look at what the BOE would be worried about under a Labour government, is it workplace? Is it how they do fiscally?
Yeah, I mean, it is fiscal. But if you look at Labour's manifesto, it's quite striking about how modest their offering is. You've got £9 billion of spending pledges funded by about £9 billion of tax rises. So in the context of a £3 trillion economy, that's pretty small. So what the BOE are going to be watching on election night, yeah, they'll see. Obviously, they'll be looking at the results come in. But I think in terms of does it affect their path going in half of this year, I don't think so. Of course, we have a budget probably in the autumn. That will be the main moment. But as things stand right now, does what either political party has announced change their thinking? I don't think so.
I mean, we have anemic growth at the moment. How's Labour going to achieve their targets?
Well, that's another great question. And it's really interesting that Keir Starmer's talking about this 2.5%, or at least 2.5% growth. And that's the sort of growth we had prior to the financial crisis. It's not something we've had since here in the UK. And it feels to me that it's sort of getting there is based on two things. One is this idea of bringing certainty and getting rid of what they call the chaos. And they think that will bring a growth dividend, maybe. On the other side, there's the fiscal element to it, which, as I say, is very, very modest. So I think that we heard Mike Brewer say there, you know, they might get lucky, but it doesn't feel to me that what Labour are saying will be the source of that growth. It might be something external, something exogenous that propels the UK economy faster than everyone has expected. Equally, there's a big risk on the downside as well, and we've been hit by a lot of negative shocks recently, and they need to be prepared for that outcome as well.
And Dan, I mean, this feels like not a huge market event because basically it's a centre-left party.
Well, that's the thing, and I think the interesting thing for investors here is, and you know, a lot of my Bloomberg colleagues have been writing about it, is the difference between now the UK seems sort of a beacon of stability if compared to what might be going on elsewhere in the world. So there's been this sort of switch around. And that possibly, you know, going to one more point, going back to the original question about growth, that might be a boon to growth as well. So I think you're right, this isn't a big market event domestically, but when you look at the UK in the context of global markets, actually it is quite a positive outcome for the UK to have a sort of stable centrist government.
Dan, thank you so much. Dan Hansen there from Bloomberg Economics. Now, coming up, a poll suggests that the Labour Party is set to win the UK election by a landslide. We take a closer look at some of the most likely outcomes from tomorrow's vote. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Bloomberg.com webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Now, as you've heard, Bloomberg's poll of polls shows Keir Starmer's opposition Labour Party firmly in the lead ahead of Rishi Sunak's governing Conservatives. Bloomberg's UK correspondent, Lizzie Burden, joins us now to walk us through some of the possible outcomes. Hi, Lizzie.
Hi, Francine. Yes, the odds are all about what size of majority Labour will get, because the polls all assume that Labour is going to win. So let me take you through the scenarios that the bookies are taking bets on in order of likelihood, starting with this scenario, a supermajority of 250 plus seats for Labour. It would be unprecedented, and indeed supermajority is a new word in the British political lexicon. It's been imported by the Conservatives to warn against giving Labour untrammelled power, because it would mean that Keir Starmer could get his policy programme through Parliament easily, and it would put pressure on Keir Starmer, in fact, to be bolder when it comes to pursuing economic growth. Actually, as I think you were discussing with Dan Hansen, perhaps that could be a boon for the UK economy. The Institute for Fiscal Studies saying that at the moment the plans look like a gamble on growth. But let me take you to the next most likely scenario according to the bookmakers. This is where Labour would get a majority of 150 plus seats. Now, to put it in context, in 1997, Tony Blair got a 179-seat majority, and Boris Johnson in 2009 got an 80-seat majority. So this would still be pretty good, but it would mean that the Conservatives do not face extinction. Now, let me take you on to the next scenario in order of likelihood, a 50-plus seat majority for Labour. There was a time when this would have seemed like an enormous victory for Labour, pre-Partygate, pre-Liz Truss's 49-day premiership. But now this would probably be a bit of a disappointment. At least the headlines on Friday would, I bet, be all about where did Keir Starmer's big poll lead go? How did the Conservatives manage to stave off defeat? But let me take you on to the next scenario. This is where Labour still wins, but they don't have an outright majority. And it raises the question what Keir Starmer would do. Would he try to form a minority government, or would he go for a coalition with the Liberal Democrats, which then raises the question, what would Ed Davey, the Lib Dem leader, try to extract in exchange for his cooperation? Would it be proportional representation, closer ties with Europe? This is not a scenario that the financial markets are likely to enjoy. Finally, the last scenario, a wild card. This is where the Liberal Democrats become the main opposition. They'd have to make serious inroads into Tory heartlands. But since the First World War, you've had Labour or the Conservatives as the official opposition, so it would be a real shake-up of the Westminster two-party system. Not impossible, but pretty unlikely, Francine.
Lizzie, thank you so much. Our UK correspondent, Lizzie Burden. Now, this is a poll of polls. This is a Bloomberg put together poll. I think we have it in just a second. We've seen actually that lead narrowing between Labour and the Conservatives. You can see that was the latest from yesterday. Labour at 40.5, Conservatives 20.1, and this is Bloomberg's poll of polls. If you look at the Liberal Democrats, they're at 11.4%. Up next, Bloomberg Brief with Danny Berger and Manish Krani in New York. This is Bloomberg.
I decided to acquire Indeed 12 years ago. When I was 36, I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big, American company. But I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the place to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
This is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Good morning from our global headquarters in New York. I'm Manish Krani alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
The S&P closes above 5,500 for its first time in history and its 32nd record this year. Powell signals that the inflation is on a downward trend. Sentencing delay, the Supreme Court ruling pushes back Trump's day in court by 3 months, while Biden blames travel for his poor debate performance. And are we finally there? Skydance is said to offer a higher valuation to close the deal with Paramount. Good morning, Manus.
Danny, good morning. I just can't wait until that family actually strikes a deal and finally gets that over the line. Paramount this morning is one of the lead stocks on the upside. Of course, there's the voting and the non-voting shares up 6.62%. So finally, will Skydance get their deal? How much are they offering? How much equity are they putting in and debt? SPOO's above 5,500 for the first time. Another one in the back of the net there, really. This is the 31st record of this year. Yesterday, you talked about the fog that Laurie Calvasina saw at RBC, and she was a nervous raise. Saw a few potholes out there. Her nervous raise takes her to 5,700. Tesla also having a banging run on their deliveries. Yes, we were waiting for that number, and again, Tesla carries through this morning up another 2.7%. When it comes to the bond markets, it was 5 words that changed the narrative. I mean, if you read Ed Yardeni's research, what he says is the Fed put is back, and that invoked some spirited attempt in the equity market, but also in the bond market. Powell's words, quite a bit of progress has been made, and a gradually cooling economy. So the jarring of the door for a September rate cut just opens. We're counting down to the UK election. 126.96 is where we are. Cable is up for 5 days in a row. We haven't seen that in a while. I love what UBS say. I'll give you this, Danny. UK, an island of stability after 10 years of looking like the problem child of Europe. Maybe you should put your money in the UK rather than France. There you go.
I think we both took away that option when we moved from London, respectively, to Dubai and then New York. But Manus, that record high, I find fascinating, because NVIDIA fell yesterday. We made a lot of noise on the way up that it was NVIDIA that was the pillar of this market. It was the only thing supporting it. Yesterday was a good example of how that's not necessarily true. NVIDIA falls by more than 1%, and the rest of the Mag 7 pick up the baton. So, okay, it's still not great breath, but it's the other ones like Tesla, Apple, Microsoft that carry this market further. So momentum is shifting, but it hasn't been violent. We're clinging on to, as Mike Wilson puts it, different lifeboats in this market.
Yeah, I mean, the air is getting undeniably thinner, or not, as the case may be, because the debate is this: we've moved from no landing to soft landing. The JOLTS number was a little bit of a surprise, I think, for everybody else. And then if you look at Sintra and the language in Sintra, the narrative, as I say, from Ed Yardeni, I was very surprised. The title of his piece this morning is that, you know, the Fed put is back because of Goolsbee and what Powell said, but Goolsbee's an archdove. So it's hard to understand where we are on the timing, but the data is certainly adding to the narrative of more of an assurity of 2 rate cuts this year.
Or just more confusion.
We'll take both.
Right. Well, I mean, this is the thing. Neil Dutta has been talking about cherry-picking data, that if you see basically a still strong government economy, what you're doing is cherry-picking. But that's all anyone is doing right now.
Yeah, but then we've just sat down to look at some of the betting odds in terms of Biden being still in power and still on the ticket. And as we said, well, it depends which website you look at. You know, you can choose your narrative, you can choose your data to suit your narrative.
Yeah, it's a confusing time, and will ECB and Fed speakers clear it up for us? We have been hearing from them from Sintra. Chair Powell and President Lagarde spoke yesterday, and here's what they had to say specifically on the labor market.
We do think policy is restrictive, and we think that's appropriate. I think if you look at the labor market in particular, you're seeing demand for labor gradually come down in the form of job openings. You can see the labor market is cooling off, appropriately so, and we're watching it very carefully.
We don't need to have services at 2%. We have to look really what is behind it. And what's behind it is a lot of wages. Services has a very high component of labor. Wages also suffer from the lag impact of the labor system that we have in Europe.
There has been this slight shift where some of the doves have been getting louder, but is it enough? Ella Hoya from Newton Investment Management writes this: the Fed overall remains backward-looking. For the soft landing narrative to take hold, enough easing of policy needs to get delivered ahead of the cycle. That window has now closed. The Fed may not ease well into September. Ella joins us now, I'm pleased to say. Ella, so are we already in policy error land as it stands?
Well, you know, we like to think probabilistically, and we would say, given some of the data surprises are coming on the softer side, and credit demand is actually also softening, so alluding to rates already being tight, as Powell was just affirming. then yes, I think probabilistically we would say the risks are for a much softer landing than the soft landing narrative would have you believe.
Therefore, do you believe that the velocity or the pace of disinflation speeds up from here?
We would think so. The odds are certainly in its favor, particularly with a 6 to 9 month window, so a little bit more short term. Medium term, the risks still remain that we get sticky inflation because of the structural reasons behind it. However, for the bond markets, I think this narrative around the next 2 to 3 quarters will be very important.
That's quite a complicated thing to try to wrap your head around, this idea that perhaps the landing won't be as soft as expected, but we are going to have a bumpy disinflation trend. So how actually are you positioning for that, Ella, of yes, softer, but yes, inflation spikes?
Well, I think the growth element will be important for now. Potentially inflation is what might keep yields from falling too much, right? So the corridor for rates is getting higher on the low side, and that's because of the shift we had since 2021. So there has been a regime shift in markets. However, what that means for us positioning-wise is now the odds favor you being long duration or having interest rate sensitivity. But in terms of where in the curve that would be, it's in the shorter maturity bucket. So because of the fiscal risks, because of the inflation risks that are still on the table for bond investors, that likely means more term premium and likely steeper curves. So that's how you marry the two together.
We've certainly seen quite an aggressive steepening in the past couple of days. I mean, we've looked at this a couple of times. In part, that's been driven by the political risk, Trump accession, inflation, tariffs, and immigration policy. So there was this narrative of a re-steepening. I just wonder to what extent now that is fully priced. I mean, it was quite a breathless spike in the 2s, 10s. Do you think that that steepening is exhausted and is only emboldened again if there is a real dramatic shift in the polls, again, further ahead for Trump?
The short answer would be no. So I think trend in steepening can continue. And if you think those are the only reasons that are driving the steepening, perhaps some of that is in the curve. However, let's not forget that it's quite typical of curves to disinvert and start to steepen as we head into recession periods. I know recession is a bit of a dirty word for markets right now, but if that is the case, then you can expect more steepening, also aided by the cycle. So particularly with the softer cycle view that we have.
What happens to the deficit if it is a softer cycle, Ella? Because now it's not that much of a threat. But what happens when this is a government where deficits are growing, but because of a softer economic environment, you're collecting less tax and paying out more unemployment benefit? Do we start caring about deficits and auctions in that environment?
Well, as late as yesterday, even the Fed was talking about the risks on fiscal and how fiscal deficits need to be tightened. So, of course, in the event of a downside in the cycle, then you can expect those deficits to widen. And this is what's kind of keeping bond markets nervous and likely to play out over the next few years or so. So I would expect that to continue widening.
Well, certainly we've been spooked before last autumn, weren't we, in terms of the auctions and in terms of the deficits. It's a question of whether that's amplified or multiplied. When we talk about real rates, Ella, looking at real rates, just under 1.99 is where we are. Again, if we're going into this slowdown, if potentially, as you say, that dirty word recession, I don't think anybody's there. I think that's still probably more a tail risk than consensus. But if we are going into this slowdown, how much or how big a scale of a cutting cycle do you think that we're in if real rates are just under 2?
Well, I mean, at least with positive real rates of those levels, you're getting some compensation for owning the bonds, even granted the fiscal risk down the road. I would say if we get into this cutting cycle and if it's a really softer outcome relative to market expectations, you can expect rates to drop to as low as 3%, I would say. You can always overshoot. As we know, market sentiment can drive things further. It was the case in December with the expectations on rate cuts. Why not on the next cycle, particularly if you have weakness economically speaking. So I would say 3% seems like a decent range. Perhaps given the longer term fiscal constraints, that could be a good selling area, say around 3% or so. But I would expect that's kind of where we're headed.
I know we're talking about the medium term, but I want to talk about the next 2 days when there's a UK election and then there's a jobs report, not to mention at a time when most of the U.S., except Manus and me, will be at a beach somewhere in the world. Just what are you expecting in this period of, again, a heavy news flow, but potentially scant liquidity?
Well, I wish I was at the beach as well this weekend because there'll be plenty worrying bond investors. Of course, we have French elections as well. Let's not forget, right? That's also an important political risk. Look, on the UK side, we would actually say UK has a positive political backdrop from an investing perspective. So UK assets are attractive. We're actually positioned that way. The UK curve is quite steep, so the long end of gilt is interesting. Pound is interesting. But you could even argue UK equities are also attractive if you're sort of a bit of a valuations-driven investor. So for the UK, less concerns. Let's see what the elections bring tomorrow, but I would expect a positive backdrop there. I would say in terms of the data on the job side, markets are pretty nervous. Job trends, particularly the forward-looking components, are trending down, and that's kind of what keeps us more in the soft landing narrative, if you like.
Double soft.
But let's see. Let's see.
Double soft,
Double
Ella.
soft, exactly. Or
there
rough,
you go.
Maybe.
Soft squared.
Or rough.
Soft squared. Tell me this, before you go, you're at home in the UK. Do you think the UK, as UBS say, has become an island of stability after 10 years looking like the problem child? Wrap it up in 30 seconds.
I'm an optimist by nature, so I would hope so. And I love the city, I love the country. So I would say yes, why not?
Oh, politically very well paid. Ella, thank you very much. Ella Hodja there of Newton Investment Management in less than 30 seconds. Some of the stories trending on your Bloomberg terminal this Wednesday morning before you go to the beach. Brevin Howard is cutting the fees for their biggest fund to make up for high costs. The firm is reportedly scrapping 1% management fee for its Alpha Strategies fund until the new year. Many multi-strategy funds have been facing fierce competition for talent, forcing them to pay up to attract new hires, which contributed to rising costs.
Meanwhile, Apple is getting an observer role on OpenAI's board. Sources tell us that Apple's App Store head and former marketing chief, Phil Schiller, has been chosen for that position. They say the arrangement will take effect later this year. And as you'll recall, Apple announced that it would offer ChatGPT in its iPhone, iPad, and Mac as part of its suite of AI features.
European officials told Bloomberg that Chinese and Russian companies are developing lethal attack drones. They say the firms held talks in 2023 about collaborating to replicate Iran's Shahed drone. A version was reportedly developed and tested this year in preparation for shipment to Russia. In a statement, China says it does not provide weapons to parties of Ukraine conflict.
Well, coming up, we'll talk domestic politics. Donald Trump's sentencing delayed by a few months as the judge reviews the Supreme Court's landmark ruling about immunity.
And a multimedia merger is agreed, is it? We bring you the details of the proposed deal between Skydance and Paramount. Are we finally there? We'll give you the context. It matters on Bloomberg every day.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's Bloomberg. Alongside Tony Berger in New York. Well, the sentencing for the former president, Donald Trump, has been delayed. We know that. The date has now been moved to September the 18th. So the judge in the case can review the impact of the U.S. Supreme Court ruling on presidential immunity. Kriti Gupta is with us now. So, Kriti, this is one of those moments of when the judge is reflecting on what the Supreme Court ruling might mean, and there's a growing narrative that the sentence may even be set aside.
There is. I mean, look, this has now been pushed back. The sentencing was supposed to be July 11th. It's now pushed back to September 18th. Now, on the surface, what this means is that this could eliminate something like jail time, which was essentially one of the options that the presiding judge, Juan Merchan, was going to talk about. And I should just put this into context. This is specifically around the case of the hush money payments to adult film star Stormy Daniels. Remember, there are other cases against President Trump as well, ongoing ones like the 2020 election. But what the Supreme Court decision has said is that even social media, any evidence brought into him or brought onto him from other cases during his time as president, that now all has to be taken out of consideration for the end casing. Now, because the decision has already been made on the hush money trial, that now affects the sentencing story as well. From a voter perspective, he is still a convicted criminal from a private act standpoint. The question is, does it just eliminate the jail time that was on the table?
Meanwhile, Kriti, you have President Biden coming out and saying, and his aides saying, look, he had an intense travel schedule before his debate. It was a poor performance. But even so, Reuters has the story that 25 House Democrats are willing to call for Biden to step down if he seems shaky in the coming days. We've already heard people come out and officially say this. Lloyd Doggett, the Austin Democrat, among the Texas Democrat, among them calling for him to withdraw. Of course, your home state of Texas. I mean, him saying that he's been traveling and that's why he sounded rasped. Is there any degree that this is resonating with the party?
I mean, look, we've heard this time and time again from his administration and his campaign, first attributing it to a cold, then attributing it to the jet lag and simply going around work. But Danny Manis, I don't have to tell you, the morning shift takes a toll on us all. What's important to keep in mind here, though, is that one of the concerns, and this came up before he even announced his re-election bid, is who the alternative actually is. If you look at the polling results, you do start to see a little bit of drop in Biden's numbers, not just against President Trump, but against candidates who aren't even expected to be on the ballot, like Gavin Newsom, like Kamala Harris. They are still polling lower than Biden, but the direction of travel is noticeable. It's also important to keep in mind simply that this all goes to the virtual roll call expected to be July 21st when he's expected to be the presumptive nominee.
Kriti, thank you very much for that. That is Bloomberg's Kriti Gupta. Okay, let's turn to the media industry now. And reports say film and TV producer Skydance has reached another agreement. This time it's a prelim agreement to buy Sherry Redstone's National Amusements and merge it with Paramount. So in sum, to buy Paramount finally. Charlie Wells joins us again a mere 24 hours after joining us on this deal before, but it was with Barry Diller. Now it's with Skydance again. I mean, Charlie, just help us make sense of it. Are we there? Is it finally happening?
Danny, I think to make sense of it, we've got to look back to some rom-coms. This is Hollywood we're talking about, after all. And really, this is a suitor from before coming back with sort of the same contours of a deal, but sweetened, just like you see when a suitor comes after somebody in a rom-com. And what we know here is that Skydance is still, in this agreement, attempting to buy National Amusements. Now, that is the controlling shareholder of Paramount Global. So they would buy National Amusements, but then merge with Paramount Global. The sweetened elements here that a person with knowledge of the matter told Bloomberg is that the valuation for National Amusements is higher than it was last time. And also, this is a really interesting sticking point, that the language indemnifying Sherry Redstone, the head of National Amusements, would be stronger than it was previously. Now, we know that Sherry Redstone was spooked by a lawsuit during the fallout of that CBS-Viacom merger. And so in the event of litigation from this potential deal, the protection there would be stronger. So those are the two changes that seem to be emerging from this preliminary agreement.
Well, certainly it's going to come down to the dollars that are offered. I think the previous offer was around $2.25 billion, and an injection into Paramount's balance sheet. Obviously, they've got a hefty debt load. If we were to talk about the probability, I mean, Danny and I sort of in the headline saying, finally, are we there yet? It's almost like a road trip with your parents. Are we there yet? Are we there yet? The likelihood that this deal gets done over the approach by other parties that we've seen, as Danny said, from Barry Diller, what makes this format much more appealing?
Yeah, man, I mean, this feels like a movie that you think is going to end, but then it just keeps going and going and going. And I think one of the issues from last time was that issue of shareholders, the non-Redstone shareholders in National Amusements. Now, they had some pushback over that idea of the merger between Skydance and Paramount. Now, what the Wall Street Journal has been reporting is that a majority of those non-Redstone shareholders would not need to approve that merger. But what is also apparent is there is a 45-day go shop period with this potential preliminary agreement, and that would allow other bidders to still bid on Paramount. Okay. So this could be a continuation of a long journey.
Charlie, we'll keep our viewers appraised every step of the way. Charlie Wells, we have done so far. Context matters on this deal every day on Bloomberg. From a beautiful New York, good morning.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Some front page news and headlines around the world. And as the New York Times has this, that Biden's lapses are said to be becoming increasingly common and worrisome. That's according to people who have spent time with the president. They say that he appears confused, listless, loses threads of conversations, and more often. And this, of course, is a problem because someone like Nancy Pelosi is talking about, look, everybody has bad debates. But the question is, this isn't a bad debate, is it? It's something that is increasingly common per sources by the New York Times.
Look, a lot of the betting sites are going hard and heavy on the probability, a less than 50% probability that he will be the Democratic nominee. This is just one site. This is Predict. There's Betfair. Look, choose your site. You can build your story. But the question is, my team. FT runs with the spotlight on tariffs. The EU takes aim at China's Temu and Shein with proposed import duties. European Commission suggests scrapping the €150 duty-free threshold. 2.3 billion imports into the EU are below this last year.
And I'll just leave you with this. The Journal has this fascinating story, Manish.
Story.
I would recommend reading it. It's about an underground network of people sneaking NVIDIA chips into China, not enough to power industry, but enough for researchers to get their hands on.
And these are students. They're being paid, we understand, according to the Journal, about $100 per chip. But to put it in context, we're talking about 12,500 chips, and NVIDIA produced 2.6 million of high-powered chips last year.
Yeah, but again, it's who gets their hands on it and what can they do with it in terms of research and building their own.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Good morning from our global headquarters in New York. I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
The S&P 500 closing above 5,500 for the first time in its history. It is the 32nd record this year as Powell signals inflation is on a downward trend. Sentencing delay, the Supreme Court ruling pushes back Donald Trump's day in court 2 months, while Biden blames travel on his poor debate performance. And finally, are we there yet? Skydance is said to offer a higher valuation to close the deal with Paramount. Danny, I can't wait for that deal to close.
You and literally everybody else, probably Sherry Redstone included. In the meantime, 32 record highs. That's where we stand. It was also another record for Mag 7 yesterday too, but all of this without NVIDIA, without the help of the thing that we said was the pillar for this market and the only thing supporting it. Maybe there is more widespread bullishness than we thought, but it is tech that continues to lead us. S&P futures, they are little changed this morning. NVIDIA down yet again in the pre-market trade. U.S. 10-year yields, those are little change, 4.43%. It was this push and pull yesterday. You had the pull from Powell, from a more dovish sounding Powell perhaps. I mean, he's always kind of sounding like that. And the push of JOLTS data that was unexpectedly strong. RBC points out perhaps it's just the boomers retiring, and that's why the JOLTS data looks like it is. Meanwhile, NYMEX crude trading around a 2-month high. The risks are there from a hurricane coming up through Jamaica and into North America. That's Hurricane Beryl, and also signs of a U.S. inventory drawdown. But man, it's just to kind of linger on Powell. We've heard the doves really start to come out more. They're not saying we're there yet, but they are getting louder and more bold, whether you look at Powell or someone like Mary Daly.
Yeah, and again, they are leaning into the dual mandate. Powell talks about things being finely balanced between inflation and jobs. Mary Daly talking about a pivot point, a turning point. And I will remind you of one thing in regards to boomers retiring. There was a producer that once that suggested to me that I was a boomer. There was a magnificent silence at that moment in time. Technically, I don't fall in.
I was going to say you definitely don't fall into
definitely, that. You know, I might have the attributes of a boomer, but I don't technically fall into the category of it.
I'll have everyone know that Manus is great at social media. Boomers famously are not great at social media. So there you go. Listen, there's some evidence in your camp.
We joke a little bit about Dan Ives. We have Dan Ives on quite often.
Yeah.
We speak to him on surveillance. We speak to him on this show. And we know that he's an evangelist of tech. The tech melt-up is beginning. Another 15% on the upside. He's evangelizing about Tesla. The story has begun. Of course, we know that's counting down to robo-taxis. And if you look at the outperformance in Mag 7, it is Apple. And it is Tesla.
I was going to say yesterday was a really good day for his thesis. Tesla is what carried the market yesterday. But again, I still come back to this thing, Manus. How long did we talk about that once NVIDIA turns, the rest of the market will turn with it? There feels to be a momentum. Exactly. Yeah. So maybe this is, okay, not the healthiest of markets, but maybe a little bit healthier than we thought.
But look at the dynamics. It's the push and the pull. It was the drag of Tesla, which was, you know, sort of the unloved child, and it was this nadir, versus the upside that was NVIDIA. And so we have this slight inversion. I'll probably have everybody sending IBs on my theory is wrong, but that's mine.
No, I love it. Again, Mike Wilson talked about this idea of a boat, and when one side tips, you run up to the other side. It tips the other way. And so what we're seeing is just this running back and forth. So it was, again, a record high on the S&P 500. It's 32nd record high of the year. 5,500 for the first time ever. Let's bring in Bloomberg MLive reporter Noor Al-Ali to talk about this. And Noor, again, I am gobsmacked by the idea that we can get here without NVIDIA because this was the pillar. So what do you make of the 32nd record high for this market?
Good morning, Danny, Manus. Look, Danny, you're talking about that boat tipping and going from one side to the other, but at some point you're going to want to jump, right? And that's what hedge funds are starting to do. They're starting to cut their exposure to U.S. stocks. They did that in June. They've cut their exposure to tech. They pivoted back into energy as well, and it's showing you that, yes, potentially we are now seeing some laggards or some underperformers really start rising, because what the market is doing really is profit taking from those names that have done very well and going into those titles as that Goldilocks narrative continues to carry itself. But I think really payrolls is that time, or is that data figure that's really going to start shifting the narratives here. Is it going to show that the labor market is actually weakening? Yes, I know JOLTS data did come out yesterday, but that is a backward-looking data set, so I wouldn't really give that much weight. We're talking a lot about, you know, the SAM rule and whether or not it would be triggered. You know, my colleagues Mark Cudmore, Simon Flint have discussed this thoroughly as well. So I think now whether the unemployment figure rises, the unemployment rate rises up to 4.1%, could really be that tipping point for a lot of people in the markets to start saying, okay, maybe the labor market isn't as strong as it is, and that's the economy turning. And when that happens, that's when you're going to start seeing more voices rising about the fact that this rally may not have the fundamentals to support it.
Yeah, and then this is where, as we said a little bit earlier, the dual mandate comes into play. You're hearing it from Mary Daly. You're hearing it from Powell yesterday. He's talking about a gradually cooling economy, a gradually cooling labour market. Quite a bit of progress on that side. The number we're looking for on jobs is 190,000. Danny and I will be here to bring the market through that, and a 4% unemployment rate. There's a small issue of a UK election. UBS say that maybe where you are is the island of stability after 10 years of looking like a problem child. So sterling's had a nice run up into this. So does that kind of narrative hold? Record highs in UK equities, sterling's on a run higher. But of course, we have the debate around whether Biden will be on the Democratic ticket. That clarion call is rising against Biden.
Yeah, absolutely, Manus. And look, that election risk, we've talked about how this year is going to be a big year for politics, and that read across for markets has continued to come through. It's instilled a lot of volatility into assets, and luckily for the UK, it's looking like it's a lot calmer now in the political front compared to its neighbors, particularly in France. Now, there are some risks in the UK, right? Like, we still don't really have a lot of clarity on fiscal spending from whichever the winning party would be. Whereas in France, for instance, you have long-term fundamentals that are essentially negative, especially those high debt risks that they've got there. And regardless of the outcome come Sunday for France, that's still an issue that whoever wins, or whatever, political dynamic, whether hung parliament or the far right winning does take place, that's definitely going to play out into markets and those fears. And that's why you see those spreads widening in France relative to its peers. But in the UK, as you say, it's a lot calmer. There's a lot more confidence.
Yep, and that's certainly reflected in the currency, the equity, and in the bond markets so far. Noor Ali, thank you very much. Setting us up nicely for our next guest, who writes this: there is no massive buildup of debt in the corporate and the household sectors, which would normally carry the risk of a debt meltdown and or a massive investment consumption retrenchment. Resilience of corporate profit and investment cycles is with us. Our guest is Shamila Whelan, Chief Economist at Westbourne Research Services. So, Shamila, good to see you this morning. With that backdrop, obviously, it's not 2008, it's not a debt crisis that we seem to be facing at the moment. Danny would probably be able to tell us the details on private credit. But for you, is it going to be a soft landing skew? I mean, our last guest said a soft landing with a soupçon risk of recession.
Hi, Manus. Yeah, I'm looking at a soft landing for the reasons that you've outlined, the ones that I've put out there. Yeah, the US economy is slowing. There's no doubt about it. We've seen GDP growth slow in the last 2 quarters to the first quarter. We're seeing non-payrolls, wage growth, hourly earnings slowing. And if you look at real wages, it's flat, right? And households are feeling the pinch. They're becoming more price conscious. So you are seeing the slowdown for sure. But as I say, there is no massive debt buildup in either the household sector or the corporate sector. The debt problem is on the government's balance sheet, and therefore, I'm not looking for a recession or a massive slowdown.
Right. So, Sharmila, how much do you worry about that debt buildup on the government balance sheet? Because you look at this bond market, and someone like Stephen Major would argue it's already priced in. The premium's already there. But then you look at auction after auction this year, well, maybe you see bumps, but they still go smoothly. So how worried should we be, especially when we look into the fog of 2025?
Yeah. Well, Danny, very good question, because when you look at, a debt to GDP ratio of 124%, you go, wow, that's big. But then you could also argue Japan's is over 200%. But the main thing in favor of the US is the dollar is still the international currency of world trade and capital flows. And, you can continue to abuse your fiscal position because you've got seniorage and you're the other thing. So it is a concern. But it's much more difficult to see a fiscal debt meltdown than you would in a smaller country, an emerging market like India or Indonesia, or for even an advanced country like Europe.
Tell me this, Shamila, then, the next 6 months, in the next couple of days, we're going to have pretty spiky volatility. We sort of know the outcome of outcomes in the UK. In France, it may be a little bit different. You're commenting about the dollar there. We're expecting a shallow rate cutting cycle from the Fed. That's the consensus at the moment. Given the political, the fiscal, and the Fed backdrop, does the dollar still remain triumphant in that global backdrop?
I think, it's like what you're going to see in the equity market, right? You're going, where my view is that you're going to see the rally continue. It's going to be broad-based. Coming on to the dollar and the currency market, similarly, I think you'll see volatility around it. And there are some very real concerns that you've just outlined. But I do see dollar resilience, right? Because going back to the point that you made, that the Fed's going to be slow to cut rates and quite measured. And again, also the U.S. economy is slowing, but it's looking at a soft landing.
Sharmila, I mean, part of the reason there is this volatility is because the volatility in the data. You look at things like a household survey that shows significant weakness in jobs. You look at the jobs numbers, the NFPs, it still shows some strength. You get JOLTS data, which also shows strength. It's what Paul Donovan at UBS is talking about this morning, that Powell seems to have trusting belief in the precision of economic data, but the declining accuracy of data reduces certainty about the state of the U.S. economy. Are we being data dependent, Sharmila, on data that is not dependable?
Danny, that's another very good question, and certainly the Fed has been very bound by the data, and data that is not very reliable, and they've been slow to move. But, as an economist, speaking as an economist, you've got to be looking at the underlying fundamentals of where are you in the business cycle, what's happening to liquidity, what's happening to broader economic activity, and leading indicators, because, things like employment are lagging indicators. Again, even inflation is a lagging indicator. You need to be looking at more intrinsic ones, like what's happening to the corporate profit cycle, what's happening to the investment cycle, what's happening to monetary aggregates. So to answer your question, I think the Fed is being very bound by the data, and the data is unreliable, and that is showing up in their hesitation to move.
Okay, Sharmila, thank you so much for that. A wider breadth of data is maybe needed. Sharmila Whelan of Westbourne Research Services. This is Bloomberg Brief.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big. With $1 trillion of assets almost, we're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
It is Bloomberg Brief. I'm Manish Krenny alongside Danny Berger in New York. Marine Le Pen's National Party is facing an uphill battle to form a majority in the second round of the French legislative elections. They come this Sunday. President Macron's centrist group and left-wing alliance are racing to coalesce in opposition to her front-running party. Let's get a little bit more with Chad Thomas. He's hunkering down in Paris. It's going to be a long run for you, Chad, through to Sunday night. I hope you got the coffee and the croissants to keep you there. Talk to me about this unwilling or willing coalition, which is an anti-national rally. Just what exactly are they tactically doing to challenge Le Pen?
Hi, Manus. Well, it definitely is an unwilling coalition, although there's a tradition of it in France. This is what's happened before in elections, both in legislative and presidential elections, where basically all the parties who are not the far right, the National Rally, Le Pen's party, they kind of banded together for the second round in order to block her from either in the presidential election last time around winning or in the parliamentary elections taking a majority. These parties don't, in the end, really have a ton in common with one another. You have the very far left party, France Unbowed, all the way over to Macron's very centrist party, all sort of agreeing that they would pull candidates from the second round in order to try and stop Le Pen's candidate from winning in those runoff races. There were more than 300 of the 577 electoral districts that were set to have 3 or more candidates in them in the second round. As of yesterday, 6 p.m. yesterday local time, they had until then to pull out candidates, and by our count from French media, more than 200 of those candidates have been pulled out by these parties in the center and on the left. So we'll be waiting actually to hear more from the Interior Ministry today, where we'll get we'll get the actual official data on how many
Chad,
of these
if I can
locations
jump in,
have a three-way or two-way.
Given
Go for it, Danny.
Because this is what markets are worried about, right? That the National Rally grips power, that it's a more right agenda. Does this calm markets, this feeling of maybe some center will prevail?
Yeah, so the markets, as you say, Danny, have been really all over the place. And when Macron called this snap vote, we had a huge market reaction. They've bounced back a little bit, and today the CAC was up 1%. It's still, though, down about 5% from when Macron called the snap vote about a month ago now. We've been hearing, though, from market participants who also say, like, look, the markets, yes, this is calming for them if they think that the far right isn't going to win a majority, but they should remember that the end result will be likely, if they don't win a majority, that there'll be a hung parliament, and that isn't great either in terms of doing things like bringing down the budget deficit that is a real problem in France as well. So it looks like on Sunday we're headed for, which is the worst of two evils here, really. There's no outcome that is being predicted at the moment that would suggest that there's going to be a parliament that allows Macron to push on with a lot of the reforms that he's been trying to put in place. And in fact, some of those reforms might get rolled back.
Okay, Chad, thank you very much. Bloomberg's Chad Thomas. Enjoy as much as you can the rest of your time in Paris. Now, there's another election we have to keep track of. It's in the UK, and for the 4th of July, the Britons are going to the polls. They look set to vote for a Labour government who have been polling far ahead of the Tory government throughout the campaign. Let's get to Bloomberg Economics' Dan Hansen on this. Dan, okay, so if we have a Labour government in, Katie Martin over at the FT wrote this wonderful column, and she said the market knows the difference between someone who's borrowing in a suit and someone who's borrowing in a clown suit. So is the Labour government someone who's likely to borrow money at a suit and keep this market calm?
Yeah, morning, Danny, morning, Manus. So, I mean, if you look at the Labour Party's manifesto, they're not going to borrow much money at all. In fact, their fiscal offering is tiny. It's about £9 billion of spending they're pledging and £9 billion of tax rises. So very, very small in the context of a £3 trillion economy. I think the key point, and it goes to the point being made in the FT article, is that if you do borrow money, it has to be credible. And if we look back to 2022, what happened in the UK, markets look at fiscal plans, and if they don't like the look of it, you get this big sell-off. But I think what will be interesting it won't be initially, but in time, if Labour do come to power, is what they do, first of all, to create some fiscal space, because there's essentially none in the UK. And second of all, if they do create that fiscal space, what they'll do with it. And their markets will be looking for a credible plan. And if you want a credible plan, you have to focus on investment spending. It's not sort of day-to-day government spending, which is deemed wasteful, and it's not tax cuts either. So I think if you want to borrow more, you have to be credible, and the source of credibility and where credibility lies, at least when you think about fiscal policy, is probably in investment spending, because that will essentially help boost the long-term capacity of the economy.
Dan, good to see you this morning. Let's see what the election brings. You've done some good work in terms of where they will spend. You talk about a housing blitz. You talk about the ability to maybe move some of the dial when it comes to investment. Look, does this shift, I mean, my favorite line of the day goes to UBS, I gotta say, which is that the UK will become an island of stability after 10 years of looking like the problem child of Europe. But from an investment perspective, the currency, you know, sterling is reacting fairly well at the moment to the prospect of a Labour government. The equity market, global equity markets are rising, so I don't think we can hand the mantle of an equity market rally to Labour. But right now, there's no whiff of panic or high vol in sterling assets right now. The market has coalesced around this. It's just a question of the size of the supermajority and what policy comes down the track in the autumn. Maybe that's when we wait for a dislocation.
Yeah, I mean, I think that's right. I mean, you've got, the question really is, as I say, the manifesto is very, very modest, and Labour are campaigning on the idea that they will bring stability, and there will be some premium in the UK for investors, but also for the economy of bringing stability to the UK. I think the question is, and Labour, just the background to this, Labour are going to inherit an economy that is recovering pretty quickly. The question is if that growth begins to falter, and if the economy goes back to sort of it's going along at a relatively slow pace, then the question is, what will they do? And I think that's what investors will be focused on and what their plan is there. And as I say, our view is that if they are going to do something, it should be focused around investment spending.
Okay. Dan, thank you very much. Those polls open tomorrow morning. Britain goes to vote. Dan Hansen on the UK. Context Matters on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
let's get you set up for your holiday shortened day. New York Fed President John Williams will be speaking in Sintra, 7 a.m. Eastern. Plus, we'll also get Fed minutes at 2 p.m. Then it's a slew of eco data, jobless claims, ISM services, Fed minutes, because tomorrow markets are off. And because of that, Manus, U.S. markets, they will be closing early today.
They will indeed. Of course, we'll get the Fed minutes a little bit later on today. We'll cover those micro movers for you. This is what we got. We got Paramount. There's a shocker. Up 8.86%. Will Skydance bring it over the line and do a deal with Paramount? Eli Lilly wins FDA approval for a new drug to slow Alzheimer's disease more than 3 years after it showed promise in the clinical trials. And Tesla romping it home, up 3.5% after the car maker reported deliveries. I mean, that was a nice run up yesterday. I think we were up 10%, 11% in a couple of days.
Yeah, again, it was the biggest mover in the S&P 500 in terms of points,
And the Max
lifting it up.
7.
Yeah, so, you know, NVIDIA goes down, Tesla picks up the mantle. Probably Tesla will go down and someone else will pick it up until we crash. I don't know.
Question is, just how much more dovish narrative will you get from Sintra? Because apparently we're making quite a bit of progress on inflation.
The linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that don't have are year long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Could face bigger challenges next.
It was going to keep bringing World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
There's parts of the market that could be allegedly overvalued, but this is backed up by a strong economy, good earnings, good consumption.
Quality factor and the momentum factor, frankly, have been just dominant in the U.S. equity market.
The earnings outlook from at least a market-weighted perspective is still supportive of those risk assets.
Business and the consumer are doing what they should be doing. They're showing up.
People are simply doubling down on existing bets because they think this party's going to keep going.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend. That feels good, doesn't it? I mean, for some of you at least. Live from New York City this morning, I can see Manus and Danny are furious because they're doing the program on Friday.
Literally everybody who's going to be working on Friday.
I apologise.
Speaking your book.
I apologise. Let's start the show again. From New York City this morning. Good morning for our audience worldwide. Equities at all-time highs on the S&P 500 coming into Wednesday. The day is short, but the day is absolutely stacked. Let's deal with the short part first. So equities closing at 1 p.m. Eastern time. The bond market closing at 2 p.m. Eastern. Let's deal with the stacked part. We'll go through the data first. ADP, jobless claims, ISM Services Index, the Fed speak, Fed minutes at 2 p.m. Eastern time. I think we get John Williams of the New York Fed in the next hour or so from Sintra, Portugal. Lisa, that day is stacked.
And to me, what I'm watching actually is ISM Services first and foremost, and then after that, the jobless claims, given the fact that we've seen this slow grind upward in terms of the numbers of people who are out of work looking to get some benefits. To me, the idea of ISM Services, if it has the same kind of downside surprise that manufacturing did, that is going to move the needle in a more significant way.
Did you think Chairman Powell was dovish yesterday?
Yes, I did.
Let's go through the quote. Showing signs of resuming the disinflationary trend. That's an additional quote from the chairman since the last meeting.
Okay, he said significant progress, real progress, and quite a bit of progress. All of that within some of his rhetoric yesterday. He did say we want to be more confident that inflation is moving sustainably down. He wouldn't talk about a date when people pressed him on September, and yet clearly you saw the market price in a greater chance of a September rate cut because of this sustainable progress, real progress, substantial progress type of language that we really heard from Jay Powell for the first time.
That's Powell. Let's do the politics. We're going to spend a lot of time on this throughout this morning. The polls, the officials opening up, the leaks, the excuse. There is a new excuse coming from Mr. Biden, the president. This is it. I wasn't very smart. I decided to travel around the world a couple of times, came back and nearly fell asleep on stage. I mean, that in and of itself sounds absolutely terrible, but let's go through the timeline. You're back from Italy on June 15th. Debate was 12 days later. And never mind the fact that you were at Camp David for about a week to really prepare for all of this and do basically nothing else.
These excuses are landing flat, to be very generous. The point is, even if that is the excuse, it doesn't get away from the basic fact that he is an older man who seems to be needing more rest and needing more time to really recuperate in a job that requires a very demanding schedule for even a young person. You look at pictures of presidents when they come in and presidents when they come out and they're great, etc. There is a chorus that is undeniable from the Democratic Party saying to Joe Biden, it is your time, step aside, and it is public and the leaks are coming fast and furious and the polls are suggesting that his chances of winning are plummeting.
Yesterday it felt like the dam was beginning to break. I saw that line repeatedly throughout the news yesterday, and to hear the former House Speaker, Nancy Pelosi, out on American TV saying, I think it's a legitimate question to say, is this an episode or is this a condition? Is it an episode or a condition?
The fact that people are saying the quiet part out loud tells you where we are. If you just look at the polls, PredictIt, for example, the betting marketplace says that Joe Biden now has only a 40% chance of being the Democratic nominee. This is a time when he is quickly losing clout in terms of his ability to actually run. When you take a look at YouGov poll, 60% think Trump won the debate. 61% of Democrats want the Democratic Party to choose someone other than Biden as their nominee. You see the dam is breaking, the chorus is mounting. Either way, the pressure is undeniable. Will the Biden camp respond?
Got two more polls for you, Lisa. CNN, 3/4 of voters say the Democratic Party would have a better shot without Biden. This was from Reuters. 1/3 of Democrats think Biden should end his re-election bid. You just see it repeatedly.
The problem is, and when you take a look at some of what has been gamed out, it's all really premature. Who has a better chance of winning against Donald Trump? That is one question, especially at a time where Kamala Harris can have the financial war chest that Joe Biden does. And then there's this question of some of the recent Supreme Court rulings, particularly with respect to immunity, and how much that also amps up some of the pressure, how much that sort of raises the temperature of the Democratic Party, given some of the doom case scenarios that people are putting out there.
Much more on that story a little bit later. Nothing doom and gloom about this market right now. All-time highs on the S&P, on the Nasdaq 100 coming into Wednesday. Equity futures just a little bit positive on the S&P, not doing much. In the bond market, yields lower by a single basis point. The 10-year 442.17. Coming up this hour, we'll catch up with James Athey of Marlborough Investment Management on why it's too early for the Trump trade. Isaac Boltanski of BTIG as Biden blames travel for the debate debacle, and Citi's Andrew Honhorst calling for a recession in the second half of this year. We begin with our top story. Investors investors positioning for a potential second Trump term. James Athey of Marlborough Investment Management writing this: isn't it a bit keen to be positioning for the Trump trade 4 months before the election, 6 months before inauguration, and based on the 2017 timeline, around 18 months before the passing of legislation? James joins us now for more. So, James, you think maybe this move is a little bit premature?
Yeah, either that, John, or really we're sort of backward engineering a narrative to describe the move higher in Treasury yields. I mean, the timing with respect to this move higher in the odds of Trump being elected doesn't seem to tie up perfectly. It almost looked to me like maybe there was a bit of inventory overhang from dealers into and out of month end, and that's just precipitated a move higher in Treasury yields led by the long end, and now we're starting to sort of engineer that into being related to an increased chance of Trump's election. So either way, for me, now is not the time to push hard on trades, investment ideas which rely on Trump passing legislation. I think there's a lot of wood to chop before we get there.
So, James, what should we rely on? You say it's too early to position for a Trump presidency. You say there's nothing clear on the macro front either. So what should I focus on and what should I do?
No, exactly. That's the difficult thing. I mean, the trend in the last 6 weeks or so has been a reversal of the trend which had preceded it, which is to say we've had some upside surprises in economic data in Europe and the UK and some downside surprises in the US. But broadly speaking, the US still feels like it's in a better place. You know, if you look traditionally at economic cycles, they don't turn on the consumer, they turn on business investment, and that then precipitates through into higher unemployment in the consumer. In Europe and the UK, we are seeing that deterioration in investment data. In the US, actually, we've seen that picking up of late. And so it still looks to us that you should be more comfortable taking duration positions from an economic perspective in Europe and the UK. We've already had one cut from the ECB. Yes, they got buyer's remorse, but I think the data is going to give them cover to continue cutting. Likewise, the bank when we get to August. Fed certainly more uncertain, but you're just getting paid that little bit more to take on that duration risk in the US. And so ultimately, we still see that as being attractive because the direction of travel is end of cycle.
This is fascinating to me, this whole idea of market move in search of a narrative, which is something that we've seen consistently. And the part of the reason why we've been playing, market ping pong or table tennis with respect to different narratives. What narrative do you paint? End of cycle, rate cutting, go into duration, probably more heavily in Europe, less so maybe in the US, but still in the US, go into dollar assets. Is this basically the game plan that you've just been describing?
Yeah, ultimately, Lisa, it is. I mean, obviously, what we're not trying to do is make some bold prognostication on the macro outlook and then bet the farm. We're trying to think about the world probabilistically. We're trying to understand the various outcomes, the various scenarios, the various themes that are affecting market pricing, deduce what we think the market is assuming, and position ourselves where it's most attractive, where the most asymmetry is. So the fact that you've got credit spreads as tight as they are and equities at the all-time highs and equity multiples looking very rich. Meanwhile, you've got yields broadly, and particularly sort of 5 to 10-year yields looking pretty attractive relative to the dynamics which are being described broadly by the economic data. That, as a starting proposition, as an asset allocator, that to us informs the idea that bonds, and particularly high-quality, safe, defensive government bonds, are the more attractive medium-term investment proposition here.
A lot of people are looking to the data that we get today. John just went through it, and then on Friday we get the non-farm payrolls report. A key question here has been, how data-dependent is this market? How data-dependent are people like yourself who don't know what macro compass to really use? What's the more important data to really be looking at in the slew of information that we get today and also on Friday?
Yeah, then therein lies the problem, Lisa, because the data that matters the most, in our opinion, ultimately is unemployment, the labour market in general. That is the spine of the economic cycle. That's exactly how these sort of positive and negative drivers feed through the economy in a cyclical fashion. The same dollar being spent multiple times, that's cyclicality. That's both, good in the upswing and then very negative in the downswing. And those changes largely happen because of changes to employment or changes to unemployment. But of course, that's the most lagging of those major indicators, and so it's difficult to make forecasts based on that. So you have to use the forward-looking data to try and inform a view on where the labour market is heading. And broadly speaking, this data has been telling us for a while and continues to tell us that things are softening, things are normalising, and again, the nature of the economy means that that second derivative is incredibly important in trying to understand where a more medium trend is. So unless we see the jobs market picking up again, it still looks to us to be an economy which is losing speed.
James, we started this conversation and you were playing down the importance of politics in the United States. I just wonder how important the politics are, how relevant the elections are in the UK and France over the next several days. James, given that this Liz Truss shock seems to have become a self-imposed debt brake across the continent, just how relevant is the politics?
Yeah, and I think that's a really important point, John. I would note the same, that I think there's been a wake-up moment for UK politicians in particular, and I think it's good politics from the Labour Party to essentially shackle themselves to the kind of fiscal responsibility that the Tories were campaigning on. From an electioneering perspective, that neutered the Tories. Their chances of winning became virtually zero at that point. And ultimately, the lessons will live somewhat long in the memory, at least for the next year or so, I would have thought. In Europe, it's almost constitutional. You have fiscal rules still within the European Union, conveniently ignored during the pandemic, but they're starting to hove into view again. Excessive deficit procedures certainly are going to be part of the future. What that means for European politics, however, is less easy to say, because you have this rise of the extremes who really are ultimately sceptical with respect to Europe and the power of the European Commission. And of course, that could set some of these countries on a collision course with Brussels. Near term, therefore, there's a lot of event risk, but actually in Europe, medium term, I think there are more structural risks to bond market pricing.
So in other words, buy the dip in treasuries, in longer-term treasuries on political risk, maybe a little bit less so over in the Euro region just because of some of these structural issues. Is that right?
Well, certainly in the non-core, you know, Germany is the safe haven. That's the core rates market. We do not favour owning a lot of the spread risk here because we think there are a preponderance of downside risks, and the market is not handicapping pricing those effectively at the moment. We'd like to see more spread before we'd be comfortable taking on some of those risks.
Hey, James, good to catch up, sir. As always, James Atty there of Marlborough Investment Management out of London. It's amazing from the market perspective how irrelevant the election in the UK appears to be in the next 24 hours.
In part, just because, A, we kind of have a sense of how it's going to turn out, but B, the Liz Truss moment maybe hangs over a little bit more significantly in that nation. So in terms of fiscal responsibility or irresponsibility, that test is already passed through.
We said yesterday, nobody wants to be the bond crisis candidate. Nobody. And these populist parties, particularly in France, and you've seen this play out in Italy too, they want to prove that they can govern. And to prove that you can govern, you certainly don't want a messy bond market. So it has become, I think, a self-imposed debt brake across Europe. Whether it should have been, that's a completely different conversation, but that feels like where we are.
Except people are still saying that spread between French bond yields and German bond yields will persist. So yes, it is a self-imposed kind of constraint, but to a point. And that, I think, is a hard thing that a lot of people are trying to get their heads around.
Well said. Yields a little bit lower over in France this morning. We're down 2 basis points. Equities here on the S&P 500, unchanged after closing at all-time highs in yesterday's session. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. Donald Trump's sentencing in his New York hush money case has been delayed by 2 months to September 18th. The delay is so that judges can review the impact of the U.S. Supreme Court ruling on presidential immunity. It also means that the sentencing would come less than 7 weeks before voters head to the polls on November 5th. Trump faces up to 4 years in prison for the criminal case. And Eli Lilly has won FDA approval for its drug to slow Alzheimer's. The drug will compete with Eisai's Alzheimer's treatment, which has been available in the U.S. since early 2023. Lilly says the drug will cost $32,000 in the first year of treatment. Both drugs remove certain toxins from the brain and are only approved for early-stage Alzheimer's, which affects 6 million Americans. A check on Paramount shares rising more than 9% in the pre-market trade. David Ellison, Skydance Media, is said to have reached yet another agreement agreement over Paramount. It rekindles deal talks that fell apart last month with a reportedly higher valuation. Skydance has a prelim agreement to buy Sherry Redstone's National Amusements and then merge it with Paramount Global. Sources say an agreement could be announced within days, though the deal could still fall apart. And that is your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, the White House still trying to shift the narrative.
Extreme weather events drive home the point that I've been saying for so long. Ignoring climate change is deadly and dangerous and irresponsible. Unfortunately, my predecessor and the MAGA Republicans in Congress are trying to undo all this progress.
We'll get the latest on the program next from New York City. This is Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Live from New York City, record finish at the close yesterday on the S&P, on the Nasdaq 100. Futures just about unchanged right now, no drama this morning. Yields just about unchanged at 442.37. Later this morning, about 2 hours away, tons of economic data, 8:30 Eastern Time. Tons of economic data throughout the morning. Mike McKee's going to be with us later to break that down for you. Under surveillance this morning, the White House still attempting to shift the narrative. Here's the latest. President Biden looking to ease concerns about his campaign, planning to meet with Democratic governors and agreeing to a televised sit-down interview. Biden also telling donors at a fundraising event that jet lag was to blame for last week's debate debacle. Isaac Boltansky of BTIG writing this. Social media posts suggest that replacing Biden is as easy as changing a fancy football lineup. But that concept crashes and crumbles against Biden's personal pride and the nomination mechanics. Isaac joins us now for more. Isaac, great to catch up with you, sir. We saw the leaks yesterday. It felt like the dam was breaking in more ways than one. I just wonder, looking at the polls, Isaac, do you think this gets worse, not better, for the president?
It's surely going to get worse over the next couple days. And I think that there is deep frustration in the Democratic Party over the White House's strategy after the debate. I mean, look, it's clear now that their strategy of downplaying this, deflecting and denying its reality has hurt them, and it's caused some of those fissures within the Democratic Party. So that strategy doesn't work. What I'm interested in is twofold. Number one, how does he look in the upcoming events? And I'm going to be looking at his appearance in Wisconsin on Friday, as well as that sit-down interview that you mentioned in the opener. And number two, what do we see from the polls? I mean, thus far, the polls have been deeply concerning. for the Democratic Party and have also given the vice president a real inside lane among some Democrats. So those are the two things to watch from here until Sunday when that sit-down interview airs.
Isaac, can you think of anything like this? I just wonder how fixable this actually is. The way the party and the campaign talk about this is as if it's just a bad debate a la Obama-Romney from all those years ago. That's not what this was. This wasn't just a bad debate. This is about whether there's something seriously structural. And I can't think of a better way of framing the question than the former House Speaker Nancy Pelosi herself when she said, I think it's a legitimate question to say, is it an episode or a condition? How do they stop making people believe, Isaac, that this is a condition?
Yeah, look, I don't think they will. I think there's a part of the electorate now for whom this is their permanent and lasting view of the president. And it's going to be very difficult to alter that. What the Biden administration is going to try to do is to say that he still has some gas left in the tank and he is a better alternative than the other guy. And this is something, John, that sticks in my mind more than anything else over the past few days, is that this race is different than ones that we've seen before, because it's incredible to me how disciplined the Trump campaign has been. If this was during the 2020 election, you would have seen Trump, concerned that the spotlight isn't on him, make it about him. Instead, he's been incredibly disciplined and let his opponent suffer with the headlines that he himself has created. And so I think that's another dynamic here that we've got to continue to watch, because ultimately that is why Joe Biden and those closest to him believe that he should remain the candidate, because he is uniquely capable of defeating Donald Trump.
Although he is a different man than he was back in 2020. And a lot of people have been saying that again and again. And the debate was sort of primetime viewing of exactly that dynamic. I just wonder what kind of timeline the current president is on to try to prove himself in any kind of way, given the fact that the momentum is building in his own party to tell him to step down. And the time is running out for actually nominating another candidate.
Look, I think that from where we are here in town, and the conventional wisdom is, let's see how the next few days go. Let's see how the next few polls go. What I'm telling my clients is I think Friday of next week is going to be the de facto deadline for seeing where the Democratic Party is. We've already seen the dam start to break in the comments from yesterday. Let's see how the Chief of Staff, Jess Zients, and what he has to say with his staff call today at 12:30. I think that's going to be a defiant tone. Let's see how we do in Wisconsin, and let's see how the interview on Sunday goes. All of that is then going to lead into the polling of next week. And I think by the end of next week, we're going to have a stronger feel as to whether this president is going to remain defiant and hope the story just shifts, or if we're going to be talking about a replacement, and we're going to be talking about some of the inter-party dynamics that are going to be at play now, 125 days before the election, that should have been at play 6 months ago.
You know, I gotta say, it's hard for me to believe that this is gonna quiet down. It feels like it's only getting louder. And yesterday was a cacophony of different Democratic Congress members, even with the first one coming out from Texas and saying, please step aside. You could see the polls that are really coalescing around this idea, with some people saying that the immunity ruling by the Supreme Court kind of turbocharged this feeling of frustration within the Democratic Party. Real question here is, what are the alternatives, given that Kamala Harris, Gretchen Whitmer, all of the potential replacements, Gavin Newsom, aren't polling that much better in a head-to-head against Donald Trump?
Lisa, this is one of the reasons that we have the situation we have, right? If there was a clear alternative, I think that there would have been more of a push within the Democratic Party 6 months ago to look at that alternative, right? But we didn't, and the party coalesced around Biden at the time, and that's one of the reasons that we're in this situation. From my perspective, I think that if we go to the next alternative, and if the president steps aside, I think that you have to look at the vice president as the clear, undeniable frontrunner. Two reasons for that. Number one is that I struggle to see the Democratic Party, a party that has embraced some tenets of identity politics, jumping over the first African-American woman in the VP role. That is not something that I see the Democratic Party doing. If they do that, I think that you're going to see some impact on voter enthusiasm. Number two, let's not forget there's $200 million plus in funds within the Biden-Harris war chest right now, and those funds need to be used by Biden or Harris. Now, of course, there's some ways around that, and that could take some time, but that is a complicating factor when we start thinking about what happens if Biden steps aside.
Just go through that, Isaac. I think it's really important, the mechanics here, the process. There's a bunch of money raised, and only 2 individuals can use it. Is it that clear, that straightforward?
FEC rules are incredibly clear on that. Now, look, you could obviously have a return of those funds and then a new round of fundraising, so there's a way around it. But what I found interesting, John, is I think you're starting to hear some of the Democrats who believe we're going to have an open race for replacing Biden say Vice President Harris shouldn't be allowed to use any of those funds until she's a presumptive nominee. So you're already seeing some of that jockeying for the replacing Biden coming out in the fight over whether she could access the funds that have been raised for a Biden-Harris ticket. It's a lot of inside baseball, but it does show you, and I think bolsters Lisa's point, that this is getting real. And we've gone from the odds of Biden being the nominee being 90% to, just a little better than a coin flip now as we await what's next.
It feels very real. Isaac, thank you, sir. Isaac Bortansky of BTIG. Lisa, just to echo Isaac's words, it's not as easy as changing your fantasy football lineup going into the weekend. It's far more complex.
Which is the reason why you see a lot of jockeying now. And frankly, the idea of waiting till next Friday sounds like an eternity to me. It's not going to just all quiet down in the meantime.
Coming up on this program, we'll catch up with SocGen's Kit Jukes. Not about rates, not about data, but about political differentials and what that means for this FX market. From New York, this is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. We do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. From the world of politics to the world of business, Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Equities on the S&P 500 just about positive. Likewise on the Nasdaq after closing yesterday at record highs. Can we add to that? It's all about the economic data today. We switch at the board and get to the bond market. Yield shaping up as follows. Your 2-year 475.80, 10-year 442.57. You look at job openings yesterday, Lisa. We did not see the deterioration that maybe some people were looking for.
It inflected upward just a slight touch from the downward trend. People were expecting to go back to pre-pandemic norms based on a couple of measures. I will say there is a lot of question around the accuracy of this data. RBC put out this note yesterday saying that actually job openings are being skewed by baby boomers retiring. So there actually are more job openings now just structurally than there would be in a normal society. All this just go to say it makes these numbers difficult to get your hands around to understand where they fit in the macroeconomic backdrop.
If jobless claims keep climbing and unemployment does too, story's going to change.
Correct.
Forget job openings. Story's going to change and change very quickly. I want to talk about foreign exchange. Haven't mentioned it yet. Lisa's on top of this one. Dollar yen came really close to 192. Or rather 162.
I was about to say,
Getting
what
ahead
happened?
of myself, you know, give it 5 minutes.
Yeah, exactly.
161.95. 161.95.
So there's this issue of what's going to sort of stop this freight train of yen weakening, given the fact that you've already seen maybe some intervention that failed completely. So why are they going to do that again, throwing good money after bad? But then this question of what if the Bank of Japan raises rates and it doesn't make a difference? And that's actually getting a lot of people nervous, including Vanguard, who's saying, if that happens, you could see 170. People talk about the actual differential when it comes to the economic trajectory and saying it actually fair value is something more like 120. There are enough people saying, we want to bet against you. We want to bet against the policy that you've been executing for the past couple of decades that doesn't make sense to us. Let's go. It's almost vindictive. I mean, you could just imagine these traders sitting around saying, take this.
Keep pushing. Keep pushing. Play out this exchange in about a month or so. Maybe we will be close to 192, coming close to 162. Under surveillance this morning, Fed Chair Jay Powell saying the latest data suggests the US is back on a disinflationary path. A slew of economic data coming throughout the morning, including ADP, jobless claims, and durable goods. That sets us up for Friday when we get the big payrolls report Friday morning. And we've heard it from a couple of guests now. They're much more interested in the unemployment rate on Friday than they are in the payrolls figure, the headline number.
Given the fact that basically we don't have a real sense of what the normal level of the jobs created is to really create a fully employed America, I'm just curious, did you think, you asked me, did I think that Jay Powell sounded more dovish? And I really think this is significant, the fact that he came out and he said the economy had made, quote, significant progress. In another place, had, quote, made real progress. And then, quote, quite a bit of progress. He has a tone, and he basically wants to believe in the disinflation that he's seen, and he wants to believe that it's on the backs of something that is just sort of a cooling of the labor market that's positive. But either way, this sounds like a Fed chair that is preparing to cut rates soon.
It talked about two-way risk, talked about the resumption of the disinflationary trend. He also said that the strength of the labor market perhaps gives us the time to wait. And I wonder if that line was the bridge between July and September. Did you get that sense as well?
Yeah, that basically waiting was 2 months, right? This isn't exactly like he's talking about waiting for the rest of the year, but yes, explaining why aren't you going now? If you do see the disinflation, right, to Austin Goolsby's point, and that is your point, that basically if you do have an employment market that's strong, in other words, if we get 150, as you hear from Citigroup, does that mean they could cut this month?
Andrew Honhorst coming up, look out for that conversation. Let's talk about travel, big feature of the last couple of days, big feature of politics apparently as well. Travel agencies warning of a surge in travel this holiday weekend. TSA expecting more than 32 million people to fly over the July 4th holiday, while the AAA is expecting more than 60 million people will drive. The numbers are staggering. We're talking about cracks in the labour market. If you're just looking at travel alone, There's nothing to see here.
This is the reason why it's so hard to get a handle around a macroeconomic narrative, just simply because when you take a look at travel, that has defied everything. Is it simply because people are still doing revenge travel? Is it still because people are prioritizing experiences? All I know is that yesterday, you actually saw oil reserves, the inventories of oil, go down. And this is interesting at a time of such big demand on a travel level. And it raises this question of, are we going to see that pop as a result of all of this travel maybe in the commodity space that we haven't really seen as of yet?
Speaking of travel, back to the politics and travel. President Biden speaking at a campaign event in Virginia, sort of blaming travel, saying jet lag was to blame for his poor debate performance. Traders are now betting on higher long-term bond yields as they prepare for a second Trump term. Kit Jukes of SocGen writing this: any upward pressure on Treasury yields will simply strengthen the dollar further. That only changes when the economy slows and rates are coming down. Kit joins us now for more. Kit, based on your note in the last 24 hours, it sounds like you think, at least in the short term, for a currency pair like euro-dollar, political differentials are more important than, say, rate differentials and what's happening with economic data.
They are at the margin. I mean, in euro-dollar, yes, and dollar-yen, no. But taking half a step back, the underlying story is that, this is the third big dollar carry rally since I started work 40 years ago. The last two didn't end until the Fed had started cutting rates. And they both went far further than anybody thought they were going to at the time, including me, though I've got an excuse for the first one because I was in my first year at work. But and this feels the same. Then the politics comes in and changes things. I think I'd say one thing about the U.S. politics that I don't really understand because I'm not good at politics generally. But the big differentiator in this cycle is that the U.S. has had more accommodative fiscal policy for longer in the post-COVID era than the rest of the major economies. So Europe's been trying to get its fiscal policy under control. President Biden hasn't, and President Trump wasn't trying to, and doesn't sound as if he's going to try to really sort of, crack down on the budget. So the fiscal difference has been a big part of what we call U.S. exceptionalism, and has been a big part of the strength of the dollar. And it's been a big part of why the Fed has not been cutting rates, because the economy's been strong, because we've had no fiscal restraint coming out from the states. So yeah, I mean, the politics drives a lot, because the fundamental difference in the United States is that the U.S. can run this kind of fiscal policy, and the rest of us have to say Liz Truss every 5 minutes.
This self-imposed Liz Truss debt break seems to be sort of gripping the whole of Europe right now, Kit, including France. France is a big conversation too. I want to talk about France and political risk in France and what it means for spreads and what it might mean for the FX market too. I want to do a little bit of a recent history lesson as well and go back, say, 10 plus years. Let's go back to 2011, Kit. I think if you have some young people on your team over at SocGen, trick question for them if they haven't watched this conversation. Tell them where spreads were in Europe back in 2011, say Italy, Spain versus Germany. Then ask them what they think the euro averaged that year. Because as you know, the euro averaged that year close to 140. And Kit, I just wonder how relevant the political risk that's starting to infect spreads is to the FX market in a single currency, because it was very complex back in 2011. It wasn't obvious. What is it now?
I mean, at the moment, the market is looking at, clearly, spreads have moved more than the euro has by a significant margin. And I think that's still, the thing that's different now from back then, in a sense that Mario Draghi did his thing then and reassured everyone that we're not letting this thing break apart on the back of that, and he stabilized the bond market. I think if I'm being fair, the stability in the bond market is a little bit unsure of itself, but we're back at 2017 levels in OAT bond spreads now, so it's still holding in. So there's a long path between where we are now and to if you like, life in 2010, 11, 12, certainly before 2015, and then the kind of the really big changes that we saw. So, we're kind of okay, provided this doesn't get significantly worse in terms of fracturing Europe potentially. So we'll have to see how that plays out. But what we've done so far is we've had a wobble in the bond market and not quite nonchalance in the foreign exchange market, but the foreign exchange market is saying that the euro is pretty low down here. This isn't a reason for us all to panic. A lot of people were short already. What I do think it does in the interim is this is going to cap where the currency can rally to for the rest of this year, for sure. In other words, the upside on Eurodollar, for anybody who thinks, yeah, this thing's cheap down here, I can't see how it gets a good lift against this backdrop.
What's the floor then, Kit? How far could it go if you see some of the political fractures escalating in France and even potentially in Germany?
We got in the short term we got to 95 in the teeth of the biggest terms of trade shock, negative for Europe and positive for the United States in your or my or anybody else's lifetime around at the moment, frankly. So the euro is very beaten up against the dollar down here, and I don't think we're going to get down to parity, you know, in the next 12 months. For the sake of argument, you know, you'll need an escalation in terms of at a European-wide level. You need to be talking about the future of Europe with genuine concern for us to get to that. We're not there. We're not there yet by any stretch of the imagination. Yeah. So we're probably where we are now is anchored at the bottom end of a historic range. Worried about the long-term lack of growth in Europe. Worried about European excess savings departing for better returns in the United States every day of the week, but not panicking on a currency base.
You point to this idea and sort of finishing up where we began, this tension between the actual economics of the moment and the rate differentials versus the politics of the moment. You say that the one big catalyst could be actually downside for the dollar should the economic trajectory weaken dramatically. This morning you said the market would need to see something closer to 150,000 in payrolls on Friday and an ISM services read that we get later this morning, closer to 50 to get really excited and start selling the dollar. What kind of downside risk do you see for the dollar, upside risk for the euro, if you get some sort of scenario like that?
I think over time, quite a big one. I mean, you know, back to these big carry rallies, but if you think that the U.S. didn't have a recession until the Clinton recession after the $85 rally, so 80-85 rally. It doubled in value against the German mark back then, and then it halved on the back of Fed rate cuts without a recession, which is, you know, both moves were ridiculously huge. So there's part of me that says the carry trade that's in, if we call it that, the amount of the way the United States corners all of the world's excess savings because the U.S. is a better place for them to be. If that flow starts going back the other way, the dollar can fall further than I can imagine. But the caveat on that is, you know, if you've got a rate cycle in the U.S. that was kind of 1 or 2 rate cuts and then they're done at a higher level, then maybe that doesn't play out because I've only got sort of 2 instances in the history of these huge moves. But it does strike me that if the U.S. looks like it's slowing and the market gets the bit between the teeth on rate cuts and the Fed delivers rate cuts, then there's a bit of a snowball movement because every dollar bear has been beaten up in the last 2 years.
Hey, Kit, great to catch up, sir, as always. Kit Jukes of SocGen joining us on the phone there to break down the latest over in Europe and stateside as well. Euro dollar right now, 107.60. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. It's Danny Berger. Hey, Danny.
Hey, John. Jamaica's prime minister has declared the entire island a disaster area ahead of Hurricane Beryl's landfall. The storm could cause over $1 billion in damages as it moves west through the Caribbean Sea. Beryl's winds have slightly weakened from a Category 5 hurricane to a Category 4. It's expected to continue to lose strength, but there's also risk that a weaker Beryl could spiral into the Gulf of Mexico next week. And Bloomberg has learned that Anglo American is weighing options to push ahead with the sale of its coal business after an explosion at a flagship Australian mine. Sources say this may include selling individual assets or excluding the damaged operations. The plan to exit coal was part of a dramatic restructuring announced earlier this year as Anglo fended off a takeover pursuit from BHP. And it is the last day of campaigning for the UK elections, and during which former Prime Minister Boris Johnson has made a last-minute campaign push to rally Conservative voters in support of Prime Minister Rishi Sunak. Labour leader Keir Starmer dismissed the strategy as desperate. Bloomberg's composite poll of polls has seen Labour ahead of every other party by at least 20 points. And that's your Bloomberg Brief. John.
Danny, thank you. We'll touch base with Danny in about 30 minutes' time. Up next on the programme, the Fed, seeing progress.
You can see the labor market is cooling off, appropriately so, and we're watching it very carefully. We have the ability to take our time and get this right, and that's what we're planning to do.
Citi's Andrew Hollenhorst up next from New York City. You're watching Bloomberg Surveillance.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Equities just about unchanged on the S&P 500. Record highs at a close yesterday across the board on the S&P, on the Nasdaq this morning. Futures going nowhere. Yields not doing much either. 442.77 on a 10-year. In foreign exchange, the euro just a little bit stronger here. 107.62 against the US dollar. Under surveillance this morning, Chair Powell seeing progress.
We want to be more confident that inflation is moving sustainably down toward 2% before we start the process of reducing how tight our policy is, of loosening policy. You can see the labor market is cooling off, appropriately so, and we're watching it very carefully. We have the ability to take our time and get this right, and that's what we're planning to do.
So here's the latest. Investors looking ahead to a slew of economic data this morning. ADP at 8:15 Eastern Time, jobless claims 15 minutes later. All of that ahead of payrolls on Friday. Andrew Honhorst of Citi saying this: we see mainly downside risks at a 155 we're forecasting. Risks at a 4% unemployment rate are more balanced, but the Fed's response would be asymmetrically dovish to a higher reading. Andrew Johnson around the table. Andrew, good morning to you.
Good morning.
Let's start with Friday. Let's skip today, and then we'll sort of work backwards. 155 with a downside bias. Unemployment of 4. Can you just walk us through how you're thinking about unemployment now? Is that a more important data point?
I think so. So we have a lot of questions about the payrolls numbers. They just continue to come in much stronger than forecast and much stronger than what we're seeing in a lot of the other labor market data. You've heard some Fed officials even starting to say, these payroll numbers look a little bit out of step with what we're seeing other places. So the nice thing,
Chairman Powell.
Including Chair Powell. The nice thing about the unemployment rate is it's a ratio. So you don't have to get the labor force right. You don't have to get the population right. You're just trying to figure out what's the percentage of people who are out of work, and that number's going up.
Implicit in that analysis, are you suggesting that one survey is better than the other?
I think there are pros and cons to both surveys, and what we would have said until 6 months ago is usually it's that establishment survey payrolls number that's the better number on a monthly basis. It has less volatility month to month. That's why that number gets so much attention. But because we're in a labor force environment where we've had immigration, we've had big shifts in the labor force over COVID, we may be getting some things wrong in the establishment survey. Firms that are being born and firms that are going out of business, getting those numbers right. The household survey, at the end of the day, you call people, you ask them, are you working, are you not working? We know the percentage of people who say they're not working.
You think that there's going to be a recession starting in the second half, probably starting in September, and that's probably underpinning some of your calls for more aggressive Fed rate cutting heading into the end of the year. And yet yesterday we saw JOLTS come out, job openings come out more than expected. We've seen record travel amounts. We were just talking about that with what airports are expecting for this weekend. We see people continue to spend pretty dramatically. How do you explain that noisiness?
Yeah, it's a mixed data environment, and that's typically what you see when you're going through an economic transition. You're going to get some stronger numbers, you're going to get some softer numbers. I think the interesting thing in the JOLTS numbers are, yes, job openings have come down, and they basically stayed at the same level. Came up a little bit in the number that we saw yesterday. But the interesting point is that we're back in terms of the ratio of job openings to unemployed individuals. That ratio, about 1.2 openings for every unemployed individual, back to where we were pre-pandemic. And what you tend to see is this behavior where once you start pushing job openings below that level, the unemployment rate starts rising more rapidly. And that's, we heard Chair Powell talking about it yesterday. We may be at a kind of inflection point in the labor market where you're actually going to see more weakness on the unemployment rate, in job growth, as we continue to push those openings lower.
People have been talking about this inflection point, and Jay Powell, as John was noting, talked about how the potential here is that they have time because the labor market is strong. Would that 155 signal to them they no longer have time? Time's up. They have to make a move.
I don't think that it signals time's up, you have to make a move. It does raise those concerns, and that's what we heard very clearly from Chair Powell yesterday, that we had been in an environment where risks were unbalanced. It was really just about upside risk to inflation. If it's all about upside risk to inflation, you know you need to raise rates, you know you need to leave rates higher. Now there's this balancing act that's playing out where Fed officials are thinking about upside risk to inflation, but downside risk to the labor market. Goolsbee, a little more dovish, Chicago Fed president, we heard him saying, I'm seeing warning signs. So Goolsbee is going to see that 155,000 and say, we should have cut back in June. I don't think Powell will be there, but 155,000, that's probably the kind of number where Powell would say, okay, things are slowing down. We're getting balance between our employment mandate, our inflation mandate. As early as the FOMC meeting at the end of this month, we should be signaling towards that rate cut that's upcoming now.
Andrew, a lot of people are using this word normalization. Let's work backwards. I said we'd work backwards. Payrolls, let's come to where we are today. Let's get to jobless claims. Can you walk me through what's normal post-pandemic and what would be the danger zone? What's the difference between the two?
Yeah, so we've been in these levels of initial jobless claims. We're running about 230, 240 right now. If that number moves up to 260, that's when you start to get a little bit concerned. And we do have some momentum upwards on initial jobless claims. You can't really compare the level to prior cycles because states are always changing the rules about who's eligible, how do you qualify. It's really the movement that you see. We're up about 30,000. If you're up 50,000, then that's when we start to worry.
If you wait for that, are you late?
Usually, that is what you see is that initial jobless claims can be a leading indicator, but they're often more of a contemporaneous indicator. And I think that's where, in fairness to Chicago Fed President Goolsbee, that is where you look at those numbers and you say, okay, 2 weeks from now, we could be another 20K higher, and then we will wish that we had been a little bit more dovish earlier.
I want to overlay the politics on this because there is sort of an existential fear underpinning some of the Feds trying to get this right, that if they don't get this right, and if there is some sort of serious recession, the response function from the fiscal side isn't going to be there in the same way. Is that your assumption, that essentially if we go into a recession that is deeper, it is going to be that much harder for the United States to get itself out without causing interest rates in the long end to go up much more considerably?
And so we have a relatively low unemployment rate, 4.0%, and we have a quite high deficit as a percent of GDP. Usually what you see in macroeconomic policy is that that deficit comes down when the unemployment rate is low. And so that does create a concern that if the unemployment rate starts rising, well, then that's when deficits usually go up. You want to spend to support the economy. It's not clear there's as much ability to do that in the current environment. Now, if we get a very deep downturn, I'm sure there will be political consensus, doing a fiscal package. The danger zone really may be, is it a kind of more mild downturn? Is it this conversation that we're having around the table this morning, where some people are saying we're seeing warning signs, other people are saying, well, no, things are really pretty strong. If you're in that environment, there's not going to be political consensus on doing more fiscal policy, especially in a world where we're already running a high deficit.
That's where some people say the Fed put comes into play. The Fed has actually now 5.5 percentage points to cut, which is very unlike the pre-pandemic level. I keep asking people this, and I don't have a real answer, which is how much and how effective can the Fed be with their rate cuts, given the fact that people don't think that the rate hikes had that big of a slowing effect on the economy?
Yeah, it's a great point, Lisa. Of course, when you reduce interest rates, that's going to stimulate the economy. It's going to bring down interest rates for some borrowers. But to your point, as we all know, it's a 30-year fixed-rate mortgage economy, and that means that when interest rates rose, for a lot of households out there that own a house, they did not experience the effect of those higher interest rates. And so when interest rates come down, you also don't experience that. And the other thing that's going on is 10-year Treasury yields are below 2-year Treasury yields, which is already reflecting an expectation that the Fed is going to be cutting interest rates. So the Fed just starts cutting interest rates now. It's not clear that 10-year yields fall that much. And then we're having this discussion about deficits. We're having a discussion about continued inflation. Those things would keep 10-year yields higher. Most economic activity is going to be more responsive to a 5-year yield, a 10-year yield. It's not really about the overnight policy rate. So there really are questions about how much can you transmit that stimulative effect of lower policy rates.
Andrew, it's good to see you.
Thank you.
Have a happy July 4th.
Yeah,
thank
happy
you,
4th
sir.
of July to you. Thank
Andrew
you.
Honhorst there of Citi. I think the fact that that is even an open question, that if we go into the next economic downturn and the deficit gaps wider, and we don't know if Treasury yields rise or fall in that situation. I mean, that's been a given for a long, long time. Yields fall, Treasuries rally, people gravitate towards fixed income, core, sovereign fixed income. The fact that we think that's an open question, that's a big change.
It's also a huge change that we had a massive counter-cyclical fiscal stimulus that increased the deficit at a time where the economy was really going quite strong. That, I think, is also unprecedented. When you take a look at the debt levels relative to GDP, that is unprecedented. A lot of aspects really defy some historical precedents in the United States.
The conversation continues. Up next on the program, we'll catch up with Jordan Jackson of JP Morgan. We'll speak to Charles Myers of Signum Global Advisors, sticking with Biden. We'll get more on that big donor in just a moment. Tom Titouris of Strategas on this bond market, and Bloomberg's Anne-Marie Hordern live from Ukraine, from New York City. This is Bloomberg.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
There's parts of the market that could be allegedly overvalued, but this is backed up by a strong economy, good earnings, good consumption.
Quality factor and the momentum factor, frankly, have been just dominant in the U.S. equity market.
The earnings outlook from at least a market-weighted perspective is still supportive of those risk assets.
Business and the consumer are doing what they should be doing. They're showing up.
People are simply doubling down on existing bets because they think this party's going to keep going.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning for our audience worldwide, with equity futures just about positive after closing at all-time highs in yesterday's session on both the S&P 500 and the NASDAQ 100. We've got quite a morning coming up for you. Let's go through it together. Let's talk about the day ahead. The day ahead looks like this. ADP, jobless claims, ISM services, Fed minutes. In just a moment, you'll hear from the New York Fed President, John Williams. Lisa, we're packing that into a shortened trading day. The stock market closes at 1, the bond market at 2.
So where's the signal and where's the noise? A lot of people looking to a two-pronged aspect here, a two-pronged show, starting with the initial jobless claims and then going to ISM services. Those two economic metrics really setting the stage for non-farm payrolls on Friday. When you start to look at the potential for services also showing the weakness that we saw in manufacturing, that could move the needle.
I'll keep going back to the framework we've used on this program now for a number of months. What is the difference between a welcome cooling and an unwelcome deterioration? Andrew Hodenhorst of Citi on the program just moments ago pointed directly to jobless claims. We asked for a number, he gave us one. He said the danger zone would be 260. 235 is the estimate today, 260 is the danger zone. And we said to him, if you wait until 260, are you late? And he said, basically, you're late.
I mean, that's what we heard yesterday from Claudia Sahm as well. When you start triggering some of these rules, and you start triggering some of these points, you've already blown it. And that's, I think, what's on the likes of Austin Goolsby's minds when they start having a more dovish tone. Question is, you see other aspects like the fact that travel is at record highs. It challenges the idea of weakness. Nonetheless, if you see a broad-based cooling across the board, even if you don't hit those trigger points, is that enough for a serious change of tone at the Federal Reserve?
That's the market and the economy. We will, of course, talk about the politics as well. Think about what we've heard in the last 24 hours, the polls, the leaks, the excuse, the new one is jet lag. Just think about what the rest of the world is thinking right now about what's developing in the United States of America, what foreign leaders are thinking about this situation. Anne-Marie Hordern, if you're wondering where AMH has been over the last couple of days, I can reveal that all to you right now. She's going to join us in about 30 minutes or so. She's been sitting down in Ukraine with the Ukrainian leader Zelensky. And I'm sure, Lisa, I know, this was a part of the conversation.
There is a real question about American leadership at a time where there's some real questions about the sitting president and his ability to keep running and who might be in his stead if he decides to step down. This is clearly a concern. We've heard this from the NATO chief. What is the American role if you don't have necessarily strong leadership at the top? The White House has said there is strong leadership. The president is still very much involved. We've heard this from Netanyahu, from the NATO leadership, from some of the unnamed European leaders who've met with him on the overseas trips.
So in about 30 minutes' time, we'll play out some of that interview for you, and we'll catch up with Anne-Marie on the ground in Ukraine. Look out for that exchange a little bit later this hour. Equity futures right now on the S&P 500 just about positive. Your scores look like this, and the bond market yields just a little bit lower by not even a basis point at 442.57. Euro dollar at 107.60. The one to watch though in foreign exchange, the Japanese yen. Lisa, here we go, getting closer to 162 at 161.93.
Vanguard saying that the real test will be if the Bank of Japan actually makes a move and hikes rates. And that still doesn't stem some of the weakness that we've seen in the Japanese yen, that they could see that getting to 170 in terms of the dollar versus the yen. They're not getting a break from the U.S. political scene that somehow has given extra juice to the dollar. And that's really the ultimate question for them. How much do they need a friend in Jay Powell? And frankly, in the U.S. electoral cycle, that has not given them anything close to that.
They haven't got many friends right now. Japanese yen, the weakest going back to 1986. Coming up this hour, here's your lineup. Jordan Jackson of JP Morgan as the S&P 500 notches another all-time high. Charles Myers of Signum Global Advisors on the road ahead for President Biden. And Tom Titsouris of Strategas on Treasury uncertainty under a second Trump presidency. We begin with our top story. The S&P 500 closing above 5,500 for the first time ever after Fed Chair Jay Powell said the U.S. is back on a disinflationary path. JP Morgan's Jordan Jackson writes in this: the strongest are getting stronger, but they're fueled on veggies and complex carbs, not short-term stimulants. Yes, valuations remain a concern, but investors can diversify into sectors like materials, financials, and healthcare, which are expected to see a very strong earnings rebound in the second half. Jordan joins us now for more. Jordan, good morning. It's good to see you in New York. Thanks for being with us. Let's just talk about it. You seem pretty constructive on this equity market into the second half.
I do. As I mentioned, the strongest are getting stronger. When you think about the Magnificent Seven, as a share of the overall S&P 500, 39% of R&D spending, 23% of free cash flow, 16% of S&P 500 CapEx. When you think about a lot of these companies are also the AI hyperscalers, they're expected to spend close to $200 billion in investment spending. So, you talk about first quarter earnings growth, year on year, up 50%. These are strong businesses. By the way, they're generating some interest income on their balance sheets, and they're making so much money, they're issuing shares or they're buying back shares and issuing dividends. We've never seen this before coming out of growth companies. So I get excited about that side, while obviously valuations, as I mentioned, are a bit of a headwind, but also for the rest of the market. When you look at the strong earnings rebound coming from materials, healthcare, financials by the fourth quarter of this year, I think this helps to broaden out and provides at least some durability in this equity market rally.
The one-year move in the Mag 7 has been amazing. The Mag 6, you strip out Tesla, it's been pretty phenomenal. Are you saying we should worry about diversification, we should worry about concentration risk, or we shouldn't worry about it?
I'm saying we should be mindful of it, careful about valuations, right? And when you think about a risk budget within an equity portfolio, you want that to be, when you need that exposure, right, to some of these companies. But I also think you want that sort of value defensive areas that look to be seeing some promising earnings growth expectations.
If we do see the economy weaken, as we were just talking to Andrew Hollenhorst of Citigroup, and he's expecting that to really percolate out in the data, particularly around employment, are all bets off? Is the sort of healthy diet of complex carbs and protein sort of now suddenly looking a little bit more like Twinkies?
Well, it's been interesting. When you look at growth holistically, it hasn't been very sensitive to movements in the treasury market. Yields are higher, but growth is higher as well, and the market continues to hit all-time highs. So I do think perhaps they may be feeling a little bit more defensive than they have historically. And also, we're in the camp that growth is cooling, not freezing over. And I think that's a really important dynamic as well. So I don't think all bets are off. And even if the economy slows, this could be a soft enough recession where it's almost difficult to say it's an outright deep recession.
There's sort of an interesting idea underpinning what you just said there, which is something that we've been hearing from people. Basically, how much a treasury is going to be the haven bid at a time when people have been hiding out in NVIDIA. People have been hiding out in growth stocks that are minting money. That has been sort of the acyclical bet on something different. Is that sort of what we can expect this time around? If we see economic weakness, if you see the labor market start to roll over, that's not going to stop the freight train of NVIDIA, of Microsoft, but you could not maybe see the same kind of rally into longer-term treasuries just because of the deficit and some of these political issues.
Sure. I certainly think there's a bit of a put on long-term interest rates. We actually think that yields are probably going to be in a pretty tight corridor for the duration of the year from about 4 to 4.5%, and we're already flirting with sort of the higher end of that. When you think about that floor, you've got rising estimates of R-star. You've got, I think, this also increased pricing as of late, perhaps a Trump victory. And he's talked about in tariffs, right? Baseline tariff. He's talked about, certainly he's going to push through all the expiring provisions on the 2017 Tax Cuts and Jobs Act. That's all going to be net inflationary. And I think the bond market is starting to feel that. But that said, if you do get a more material slowing, I do think you're going to get long-end treasury yields rallying a little bit here. And perhaps, though, interestingly, in the next recession, and if it's a deeper recession, maybe balance sheet policy is going to be more important than interest rate policy. That back end, the Federal Reserve impacting long bonds and long rates.
Let's just sit on the long end. So you've got this range of 4 to 450. I think your rate cut call for this year is only one cut for 2024. Implicit in that is basically an inverted yield curve for the rest of this year. Do you think that the Trump presidency has the potential to change that, given the bear steepener that we've seen over the last couple of days? Just the steepness starts to come through, but driven by the back end.
You've already seen a little bit of that bear steepening kind of play out, really since that peak inversion since July of last year. And the steepening has really been happening at long rates, kind of moving higher relative to where in the middle of last year. I do think, though, the next steepening out that we do see is going to be a bull steepening. So I do think it's going to be the market. As soon as the Fed starts cutting rates, the market tends to jump the gun. And they may very well start to price in more aggressive rate cuts, and that's going to bring the front end of the curve down. But I don't think the curve is going to be positively sloped, perhaps into the second quarter of next year, maybe even not until the second half of next year. So I think this is going to be an environment where the yield curve is going to stay inverted. In that environment, you need to perhaps maybe barbell the yield curve from a duration standpoint, and I'd probably assign 65%, 35%. That 35% is a hedge against the risk that something more sinister plays out in the economy.
I like how you looked at Lisa when you made that point.
I know.
Thank you. You know this program well. Jordan Jackson at JP Morgan. Jordan, it's good to see you. Thank you, sir. If something sinister happens, Lisa.
I know, exactly. I know that I sort of come up with the catastrophic scenarios. Literally, I sit at home sort of, worrying about catastrophic situations.
You write them down.
I do. What happens if the yield doesn't go down in the face of weakness? Yeah.
I'm ashamed to say that when I lived in London, Anne-Marie used to bring back Twinkies for me from New York.
So you ate Twinkies?
I actually ate some Twinkies.
Do you have pictures?
Yeah.
Pictures, I don't believe you.
I don't know if I have pictures. I'm sure they're still in my body somewhere. It's a long time ago. Still trying to digest those Twinkies.
Yeah, stashed in your left leg. Look, this to me, I just wonder, getting bigger and the diet of complex carbs and protein. There is truth to that, right? It's sort of been vaguely healthy. What happens to change that?
Okay. All right. Okay. We've been serious again now. All right. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Bloomberg has learned that Apple is getting an observer role on OpenAI's board. Sources say that App Store head and former marketing chief Phil Schiller has been chosen for the position. They say the arrangement will take effect later this year. The move puts Apple on par with Microsoft, which also has a non-voting observer role. Apple earlier announced that it would offer ChatGPT in the iPhone, iPad, and Mac as part of its AI features. And Donald Trump's sentencing in his New York hush money case has been delayed by 2 months to September 18th. The delay lets judges review the impact of the U.S. Supreme Court ruling on presidential immunity. It also means the sentencing would come less than 7 weeks before voters head to the polls on November 5th. Trump faces up to 4 years in prison for the criminal case. And Anne-Marie Hordern sat down with Ukraine President Vladimir Zelensky and asked him what it would take to win the war with Russia.
I would like China to play a serious role in Ukraine. It's a big country, and really it's the second largest economy, and Russia really depends on it because they don't have another place to export many of their goods because of the sanctions.
And we'll bring you more of Anne-Marie's interview with President Zelensky in about 15 minutes' time. And that's your Bloomberg Brief, John.
Danny, thank you. Looking forward to catching up with AMH at about 7:30 Eastern Time. Up next on the program, the dam begins to break.
He has a bad night. Now, again, I think it's a legitimate question to say, is this an episode or is this a condition?
Is it an episode or a condition? We'll get you an opinion on that next. From New York City this morning, good morning.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equities right now in the S&P 500 just about unchanged. Record highs at a close yesterday. Let's see what Wednesday's got in store. So far for Q3 though, gains on Monday, gains on Tuesday, just about unchanged on Wednesday. In the bond market, yields unchanged at 442.96. The bond market has not been looking at the data or the Fed speak over the previous few days, particularly Friday and Monday. This bond market was staring at one thing, the latest in the election in America. Under surveillance this morning, the dam beginning to break.
He has a bad night. Now, again, I think it's a legitimate question to say, is this an episode or is this a condition? And so when people ask that question, it's completely legitimate of both candidates. Both candidates owe whatever test you want to put them to in terms of their mental acuity and their health. Both of them.
So here's the latest. Pressure mounting on President Joe Biden to prove last week's debate was just about night. Worries in the Democratic Party growing after Puck News published a leaked poll which showed Biden's favorability ratings plummeting the most in nearly 3 years. Major Biden donor Charles Myers of Signum Global Advisors writing this: I'm all in on Biden. His performance in the debate was weak, but his performance as president for 3.5 years has been very strong. Charles, I'm pleased to say, joins us now for more. Charles, great to catch up with you, sir. As you know, for many people, after Thursday night, it's not about the last 3.5 years. It's about the next 4.5 years. And let's run with the Pelosi question. How do we know that was just a bad episode and not just a condition?
Yeah, look, I think the president and his team have a lot of work to do to get him out there to show the American people that he is fit, that he is alert, and that he can not only run the rest of this campaign, but that he can govern the country for another 4 years. So, you know, again, I think that they do have work to do. I think what Nancy said is absolutely accurate. The things are moving a little faster than I expected. I thought they'd have at least 2 or 3. We were telling our clients they'd have 2 or 3 weeks of polling before they would have to make a decision. I thought, this is a personal opinion, I think they've got probably another 5 to 6 days. I think that things are moving much faster against the president, and we'll see. But they are getting him out this weekend into the swing states, and we'll see how he does on the ABC interview with Stephanopoulos.
What do you think Chelsea needs to accomplish in those 5 days? What does he need to do?
I think he needs to be unscripted and show people that he is fully there and can make decisions, interact with people. I was with him on Friday night in New York, one-on-one at a big event, but then had about a 3 to 4 minute interaction with him one-on-one. He was very together, very alert. So he needs to show that to the American people instead of this perception that has been lingering of him post-debate of someone that is, really out of it.
Charles, isn't the damage done, given the fact that people are really questioning whether they're being told the truth, especially from some of his advisors? And you have a number of Democratic congressmen, including one from Texas, now verbally saying that they hope he steps down. Does that mean that there already has been too much to shake his reelection chances?
Yeah, so I'd say a couple things. One, the campaign expected polling, to take a hit, and the PUC stuff that was leaked, was pretty damaging. But again, I think you need to see more than just one poll. You need to see a set of polls over a week or so, and see if they can turn it around. But yes, I think a lot of damage was done. I'm fully on board with that. I understand it. So far, only one sitting member of Congress has called for him to step down. I do think that could be the next shoe to fall, though. Meaning, there's reporting this morning that there's potentially 40 additional elected Democrats that are going to come out and call for him to step down. That is probably the most serious issue, that in addition to further deterioration in polling, because once you've got elected members of your own party asking you to step aside, it's hard to recover from that.
There's also a question of who potentially would take his place. And this has been one of the arguments from some people who are saying that, he's the best shot, sort of to your point, because the other potential candidates, whether it's Kamala Harris, whether it's Gretchen Whitmer, whether it's Gavin Newsom, kind of pull similarly in a head-to-head matchup with Donald Trump. Do you feel like there is sufficient polling to really make that decision, given the fact that some of it isn't that extensive?
Polling to make a decision on who should replace him, or if anyone should replace him?
Both.
Okay, so yes, so on Plan B is absolutely the vice president. I'm here to tell everybody that, and that she may not be the favorite of every donor. A lot of donors come from financial services, and we tend to be a center-right industry. But any notion that the White House, the DNC, or the Democratic congressional leadership is just going to overlook the vice president and go to some other candidate or have an open contested convention, I think is a misread of the situation. The whole point of the vice president is to step in the case of death, incapacitation, resignation, or in this case, the president stepping aside. And I can tell you they're going to try to do everything they can to avoid a contested convention, given what happened in 1968. LBJ's VP did ultimately win that nomination. He was so weakened, they lost the White House to Richard Nixon. I think that if Biden steps aside, they will try to engineer it so that Kamala, the vice president, ultimately locks up the nomination.
Charles, I think it's worth pointing out to our audience that you're wearing two hats in this conversation, as both a donor and an individual running a global advisory firm. And forgive me for saying this, and I hope you take this in the spirit in which it's intended. When you said you had a 5-minute exchange with him, when it's behind closed doors and you tell people that he's sharp, cogent, these are things we've heard a million times, and then we all see him in public, and not just Thursday night, for a length of time now, and we see something else. And I just wonder how much tension there is between you as a donor and the opinion you offer on a program like this and the kind of advice that you're giving to clients right now.
Yeah, so I'm giving the same advice. We've had a base case that Biden would win. We haven't changed that yet because he's still in the race, and Thursday was less than a week ago. So as a firm, we don't whip our calls around. We want to try to look at data and make a good assessment. The reason we believed he would win is he'd already beaten him once in 2020. He's got power of the incumbency, and we think as a firm we will see higher than average turnout by both women and the Democratic base. Women because of abortion rights, and Democrats Democrats because Trump's on the ballot. Now, I think the race has changed fundamentally since Thursday night. Absolutely. We want to see if he's going to stay in the race before we make any additional call from here. So I'm sitting here both as a donor watching this very closely, but also as the head of a firm that advises clients on what to do. I think it's hard to make a decision until we have a little more clarity on what the president intends to do. And I think, as I said, we were telling clients yesterday on a call that we thought there was 3 weeks for the White House or for the Biden-Harris campaign. Yeah. I think they've got 5 or 6 days to make a decision.
Let's lean on the latter just a little bit. Your position as an advisor, can we just lean on that a little bit more? I want to understand from your perspective. Traditionally, the incumbent would have some advantages. I just wonder if it's actually a disadvantage for Biden. If you think about how 2020 played out, he got to make this a referendum on the former president. This feels like a referendum on him and not what he's delivered